To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
Now we have understood how to identify a financial asset, a financial liability and an equity instrument. Let's now move on to the next aspect where we will understand how do we classify and account for these instruments. Now please remember, classification of financial instruments is very important. I am not talking about financial asset and a financial liability. Say we take a financial asset, how do we classify this financial asset will determine how we account for the financial asset, right? So first level of classification is financial asset, financial liability and equity, and subsequently financial asset. When we talk about, for example, you have to understand how do we classify these financial assets and how do we do the accounting for it. Now to begin with, we will start with the classification of financial asset, and when we have to account for financial asset or when we have to classify the financial asset, they are classified into three categories or three types. The first one is at amortized cost, meaning to say the financial asset will be accounted for at amortized cost. The second one is fair value through other comprehensive income, which we generally call as FVT OCI, and the third category is fair value through PNL, that is FVTPL. Please get used to these terminologies: amortized cost, fair value through other comprehensive income and fair value through PNL. These are the three categories of financial asset, and how you classify will determine how you subsequently account for these financial assets. Now, one principle for accounting of financial instrument, that is financial assets and financial liabilities, is that initially you will recognize them at fair value. All financial instruments, whatever is covered, you will initially recognize them at fair value. Okay, that is the first thing. Subsequent measurement depends on how you classify. So if you have classified it at amortized cost, you will carry it at amortized cost. Then fair value, you will carry it at fair value. The gain or loss may be taken to OCI or PNL depending on how you have classified. So first we will understand classification aspect of financial asset. What are the factors to be considered? What are the tests to be done? And then we will see how to account for financial assets. So I just told you that financial assets would be subsequently measured depending on their classification, whether they are measured at amortized cost or fair value through other comprehensive income or fair value through PNL. Now, why these kind of classification? What is the intention behind that, and how do we do this classification is what we are going to understand. First, let us understand the logic behind classification. Okay, say for example, I as a person, I have invested in bonds of a company or bonds of a government, say for example government. Okay, now when I have invested in the bonds of the government, my intention is to earn or to receive regular interest payment based on the coupon rate. Say for example, it is 8% bond, so on 1000 rupees I will receive 80 rupees every year, and at maturity, let us say after 10 years, my intention is to collect or redeem the bond and get the money back from the government. Okay, that is my whole intention. That is what I want to do with the bond. Now, this bond, particular bond, is also listed in the market. So, in the market, you can go and you can sell the bond if you want to. But what is my intention? What is my intention? My intention is to hold it till maturity. I don't want to sell it. Okay, I am only interested in every year I will receive the interest, and at the end of the 10th year I will receive the principal. Now in the market, as and when the interest rates go up or come down, the value of the bond would fluctuate. Say for example, RBI increases the repo rate, the interest rates in the market also are generally going up. Now when the interest rates in the market are going up, what will happen to the value of the bond? The value of the bond will go down, because in the market you are getting a higher interest rate. Similarly, if interest rates fall, the value of the bond will go up. Will that impact me? It will not impact me, because my intention is not to sell it in the market. So what am I asking here? What is my intention? What do I want to do with this particular bond? I am only interested in the contractual cash flows. I have entered into a contract with the government. Government will periodically give me cash. I have a right to receive cash, and at the end of the tenure, at the time of redemption, I will get back my principal, right? That is my intention. What happens in the market, the prices go up and down, is not relevant to me, right? It is not relevant to me. Now, this is one case, or this is one investment that I have made. Say for example, you also have invested in same bond. You have also invested in the same bond by paying 1000 rupees. You have invested in the bond. But your intention is to take advantage of interest rate fluctuations in the market, and whenever the prices shoots up, you want to sell it in the market. Now tell me one thing, will you be impacted by the movement in the market? Definitely yes. If the prices go up, you will be happy. If the prices come down, you will be sad, because your intention or your purpose of holding the bonds is to go out and sell in the market at a future period. You don't want to hold it till its maturity. Your interest is in maybe to receive interest, but as and when you get that opportunity, suddenly the interest rate starts dropping, the value of the bond goes up, you want to sell it in the market, right? Now, if we have to account for these financial assets, one, from the point of view of me who holds it for the intention of getting only the contractual cash flows, I am not interested in selling. Now tell me one thing, will fair value impact me? It will not impact me. The prices, whatever happens in the prices, I am sleeping peacefully. I have kept the government bond under the mattress and I am just relaxing, right? But for you, every day in the morning you will check the price. Oh, prices went up today. Interest rates. What will RBI do? What will happen if the interest rates fall? What will happen if the rating of the government goes down? We have the sovereign rating, right? What happens if it goes down? What happens if inflation rate goes up? You are concerned with so many risks, and the moment prices go up, you are looking at profit. The moment prices fall down, you are staring at losses. So for me, it's okay if I carry it at cost or if I record the investment at cost in my books, because I am not concerned with fair value fluctuations. But for you, fair value fluctuations are very important. Tomorrow, let us say the value of the bond doubles for whatever reasons, okay, the value of the bond doubles, then you will be super happy and you would want to go out and tell everybody, and you have actually made that profit. Similarly, if the prices fall, you will have to disclose, right? You may have to tell it to your parents or whoever has given you that money that the prices have come down, we are looking at losses. So the purpose of classification is to handle these two different type of situations. One, where I am only bothered about the contractual cash flows, I will carry it at amortized cost, because I can record it at cost. Fair value changes does not affect me, and that is purely based on my intention. For the same instrument, for you, fair value makes a difference, so you will carry that particular asset at fair value when you subsequently measure. So you will recognize the gain or loss based on the fair value fluctuation. When to take it to P&L, when to take it to OCI, that we will understand subsequently. But this understanding you need to have as to why are we classifying financial assets into three different categories, right? Now, what the standard says is, to classify, you have to look at the intention of the entity, and the standard suggests two tests. The standard suggests two tests. The first test is a business model test. Basically, how is the business model structured? How does the entity handle the assets? How does the entity manage those financial assets? That is the first part. Second part is contractual cash flow test. So these are the two tests that we need to look at to classify financial assets as financial assets measured at amortized cost, fair value through OCI, and fair value through P&L. Let us now understand the concept of business model and how it impacts the classification of financial assets. First of all, what is business model? A lot of you would have already learned about this at your earlier levels, maybe forgotten by now. Let me just explain to you by giving a very simple example. Say for example, this entity is Bajaj Finance, and Bajaj Finance lends money to borrowers, right? What is the business model here? The business model here is to lend money, to give personal loans and collect loan and interest at the end of the period, right? That is what the company does. Now, while doing that, it will evaluate what are the credit ratings of the customers, how risky it is, what should be the interest rate charged depending on the credit risk and all of that. It provides loans, right? Now, when this entity Bajaj Finance provides loans, there may be cases where there are loan defaults, right? Some of the customers may not pay back the money. Maybe after 3 or 6 months, the entity realizes that for some customers, the credit risk has become very high. They have not repaid the amount. Then what will the entity do? The entity may, they may do all those recovery things and all of that, but ultimately the entity may try to sell those receivables, that is the loan amount which is receivable from the customers, to another entity. Say for example, the other entity is a asset reconstruction company, just a hypothetical company. There is an ARC, right? Now what does this ARC do? This ARC will buy loans from Bajaj Finance and maybe try to recover it, or maybe subsequently sell it to another company, right? Now there are two entities here. In case of both the entities, there is a contractual right to receive cash, but then the business model of Bajaj Finance is to provide loan and recover those loans, right? They are not into buying and selling of loans, but this asset reconstruction company, the intention is to buy the loans from Bajaj Finance or similar companies, and subsequently if the credit rating of the customers improve, they may sell it or they may realize it, right? Both the things are possible. So this is what we call business model. How the entity manages financial asset is what is determined by the business model. All the companies do not have the same business model. As I gave you one example for both of us, my business model was to hold the asset till its maturity. Your business model was to buy and sell, take the advantage of market price fluctuations, right? So the business model basically tells us how the entity is managing its financial assets, right? So we are not looking at one investment or one financial asset. A group of financial assets, how is the entity managing, and that is what determines the business model of the entity. Now we have understood that business model is nothing but how does an entity manage its assets, manage its financial asset, how does the entity run its business, right? And in that, how are the financial assets managed by the entity? What is the intention of holding that financial assets? How will the entity make money out of those financial assets? All of these are given by business model. Now there are some factors which help us determine the business model of an entity. So basically the standard gives us 3 broad guidelines which has to be considered in determining the business model of the entity, right? The first factor is how is the performance of business model and the financial asset held within that business model are evaluated and reported to the entity's key management personnel. So first thing is how is the financial performance of the business model and the financial assets evaluated and how is it reported to the entity. And please remember, a single entity may have different business models, and each business model may have management of multiple financial assets. We are not looking at a single financial asset but a group of financial assets within a particular business model within an entity, right? So the first thing is how do we measure the financial performance of the business model as well as the financial assets. Then second one is what are the risks that affect the performance of the business model and the way in which those risks are managed. Now I gave you an example that a company gives loan. Now there is a risk when you give a loan that the other party may not pay back the loan, correct? How are those risks evaluated? How are those risks identified and how are those risks managed? That can be one factor that you need to consider. And the next thing is how the managers of the business are compensated. So how is the compensation given? Do they get some compensation based on the return that is generated by the business or the return that is generated from the financial asset? For example, again when we are giving loan, if the NPAs are less, if the non-performing assets are less, maybe the managers get a better compensation. So you have to consider these factors and then you have to evaluate the business model. Let's now have a look at few questions and examples to understand the business model aspect of an entity. So an entity holds investments to collect their contractual cash flows. So the investment is held for what? To collect the contractual cash flow. What are these contractual cash flow? If it is for example a debt instrument, the contractual cash flow will be the principal and the interest, right? The funding needs of the entity are predictable and the maturity of its financial asset is matched to the entity's estimated funding needs. Okay, so the entity may have some funding needs, maybe to buy some asset or maybe to repay a loan or something, right? So it needs money and these financial assets, the timing of the cash flows are matched with the funding needs. The entity performs credit risk management activities with the objective of minimizing credit losses. Now, why would the entity have credit losses? Say, if you have made investment in debentures of a company, say for example, it is DHFL, okay, Diwan Housing Finance. Now, once the credit rating of that entity starts deteriorating, you will start facing the credit risk. You will have the credit risk. There may be a default. You may not get back your money. So, you have to continuously monitor the credit risk aspect, what the entity is doing. In the past, sales have typically occurred when the financial assets credit risk has increased such that asset no longer meet the credit criteria specified in the entity's documented investment policy. Now, what is this big sentence all about? If you look at the earlier paragraph, what did it tell us? It told us that the entity is interested in the contractual cash flows, that it wants to receive contractual cash flows to match its funding requirement. Now, the second paragraph is telling us that whenever the credit risk increases beyond the acceptable credit risk limit, then the entity sells off those financial assets. So, whenever the entity believes that the credit risk has gone up, then the entity will not wait till the contracted date, the entity will sell off. Now, whether the business model in this case is to collect contractual cash flow or to collect contractual cash flow and sell the assets. Now please remember, the way you have to determine business model is to consider the regular transactions or regular circumstances. Regular circumstances or regular transactions indicate that the entity is interested in contractual cash flows. Yes, when are those sales happening? Only when the credit risk increases, right? So beyond a certain acceptable limit, if the risk increases, that is when the entity is selling. So selling the financial asset is not the business model, it is not a regular occurrence, right? Reading further. In addition, some infrequent sales have occurred as a result of unanticipated funding needs. So, some sales have also occurred, not because of credit risk, because of unanticipated funding requirements. Maybe some urgency came up, they needed money and then they sold the financial asset. Now, these sales are not significant, they are insignificant. When you look at a lot of financial assets, a portfolio of financial assets, such insignificant transactions may happen, right? As in when you need money, they may sell some small portion to meet their emergency funding requirement. Reports to key management personnel focus on the credit quality of the financial assets and the contractual return. So, what are we reporting to the key management personnel? Overall credit quality and contractual cash flows. The entity also monitors fair value of financial assets among other information. So, here the entity is also monitoring the fair value of its financial asset. But then, if you look at the overall structure, what is the most important aspect in this entire business? It is to hold financial asset to meet the funding requirement on those specific dates. So basically the entity is interested in getting those contractual cash flows. Selling because of credit quality may happen. Selling financial assets because of certain requirement of finance, that may also happen. But then majorly the entity is focused on the contractual cash flow, and that is what is being reported to the key management personnel as well. So what is the business model here? Business model is to collect contractual cash flows from the financial assets. Yes, we are looking at fair value. Now here the entity is monitoring fair value, but that is only for monitoring purpose. How are they reporting it to the management? They are reporting the credit quality, they are reporting the contractual cash flows. Yes, there are some insignificant sales happening. So because they are insignificant, we will anyways not consider. And because of poor credit quality, if we are selling off something, selling off some financial asset, that is also a routine transaction, but the underlying intention, the main purpose is to hold it for contractual cash flows. So basically the business model here is to collect contractual cash flows and not to sell financial assets. An entity's business model is to purchase portfolio of financial assets such as loans. Those portfolios may or may not include financial assets that are credit impaired. Now what is the meaning of this, buying and selling loans? Do we get to buy and sell loans in the market? Yes, there is a market. They are not yet matured in India, but there is a market where companies, entities can buy loans and they can sell loans. So why would they do that? See, if you go back to the example that I gave you of Bajaj Finance has given loan to a customer. Now the customer is not repaying. Bajaj Finance has tried all its ways. It tried to call, it tried to threaten, whatever is possible they have done, but the customer is not repaying. Now Bajaj Finance doesn't want to waste any more energy on that customer. So what it does is, based on the credit risk, based on the repayment history of the customer, they will define, okay, from this customer, if I have given 1 lakh, even if I get 50,000 from that customer or from somebody else, then I am happy. Okay, so what is Bajaj Finance doing here? It has given 1 lakh of loan. It is saying, okay, the customer is not paying us. Even if I get 50,000, I am happy. So Bajaj Finance finds a buyer who is interested to buy that loan for 50,000. Now this buyer who has bought that particular loan, he will try to collect as much as possible from the customer, maybe 70,000, 75,000, 1 lakh, whatever it tries to collect. Or it may find another buyer and sell it off at maybe 55,000 or 60,000. Okay, so these kind of transactions do happen. As I told you, in India, the market is not yet fully matured, right? We are still at nascent stages. But this kind of having loans as a bundle or a portfolio of loans being sold to another party, it exists. Okay. In fact, Yes Bank has sold a lot of its test asset, the NPAs and all, to asset reconstruction companies. So such transactions do happen. Now here the business model is what? To purchase portfolio of loan. If I am seeing an opportunity, I will buy stressed loans, and if at all I can recover the amount, I'll make a lot of money, right? So you'll also see cases where some companies, they buy junk bonds of other companies. Means companies whose credit rating is really bad, and they'll go and buy the bonds of that company. There is a risk of default, but then if the entity survives, for example, in case of Jet Airways, okay, they may buy bonds of Jet Airways because the airline company is anyways going to go down. But subsequently, if it revives, if at all it revives, they'll make a lot of money out of it, right? So risk is involved, obviously reward is also accordingly commensurate, right? So coming back to the question, the business model is to purchase portfolio of financial assets such as loan. Okay, they may include or not include assets which are credit impaired. Credit impaired means basically your NPAs or bad debts. If payment on the loans is not made on a timely basis, the entity attempts to realize the contractual cash flows through various means. For example, by contacting the debtor by mail, telephone or other methods. The entity's objective is to collect the contractual cash flows, and the entity does not manage any of the loans in this portfolio with an objective of realizing cash flows by selling them. Okay, so this entity will buy loans, okay, from other entities, and what is the objective? They will follow up with the customer, they will chase customers, and they will try to collect the money from the customers. They don't want to sell it to another entity. In some cases, the entity enters into an interest rate swap to change the interest rate on a particular financial asset in a portfolio from a floating interest rate to a fixed interest rate. So, in some cases, they may enter into interest rate swap. For example, if there is a loan on which the entity will receive fixed interest rate, they may enter into a swap agreement with another party and convert that into a floating rate instrument. All of these you will understand in financial management. Okay, basically they are swapping. I have a fixed loan, you have a floating loan. We enter into an agreement saying that I will pay the fixed interest rate for you, you pay the floating interest rate for me. Okay, that is what is the interest rate swapping in simple terms, right? Now here, what is the business model? Again, predominantly if you see, the business model is to what? Is to collect the contractual cash flows. Selling is not a part of the business model. Again, it's only in some cases the entity enters into interest rate swaps. So that is also not the main part of the business model. The business model, the main objective of the entity is to collect contractual cash flows. Let's have a look at another question. Entity B sells goods to customer on credit. Entity B typically offers customers up to 60 days following the delivery of goods to make the payment in full. Okay, so normal sale transaction. Entity B collects cash in accordance with the contractual cash flows of trade receivables and has no intention to dispose of the trade receivables. So again here, what is the intention? Intention is to collect money from the debtors. They don't want to sell the debtors. Sir, can we sell debtors? Yes, you can sell debtors. Like you can sell loans, you can also sell debtors. There is a concept called factoring where there is another party who will buy the receivables from the entity. But here the entity wants to collect the receivables, and hence what is the business model? The business model is to sell the goods and collect contractual cash flows from the financial asset, right? Maybe after the due date of 60 days. Let's have a look at another question. An entity anticipates capital expenditure in a few years. So after some period of time, they need money to spend on capital expenditure. The entity invests its excess cash in short and long-term financial assets so that it can fund the expenditure when the need arises. So whatever is the surplus cash, they put in some short-term and long-term financial assets, maybe investment in some bonds or investment in some FDs and all of that. And the cash flows from these financial assets will be used to fund the capital expenditure. Many of the entity's financial assets have contractual lives that exceed the entity's anticipated investment period. So, the financial assets have contractual lives that exceed the entity's anticipated investment period. What do I mean by that? Say for example, the entity needs money in 2 years' time, but the contractual life of the financial asset, say for example, they have investment in bonds. The life of the bond is 3 years. So, the money will be received only after 3 years as per the contract under the bond. Then how will they get the money after 2 years? They will have to sell the financial asset. So here the entity will get contractual cash flows by maybe way of interest, first thing. And second thing, they will get the contractual cash flows by selling the asset. So here we have come to a first example where we are saying that the entity will sell the asset and get the cash flows. The entity will hold financial asset to collect the contractual cash flows, and when an opportunity arises, it will sell financial asset to reinvest the cash in financial assets with a higher return. The managers responsible for the portfolio are remunerated based on the overall return generated by the portfolio. Evaluate the business model. So here, what is the business model all about? To get contractual cash flows, maybe in form of interest and all of that, and also to get cash flows by selling the financial assets. So here the intention is not to hold the asset till maturity. Whenever opportunity arises, they will sell the asset. Whenever they get a good rate, they will sell the asset. If the term is shorter, and in some cases because the term is longer, they may sell well in advance to realize the cash flows. And as and when they realize cash flows, they will again reinvest it in some short-term securities so that the returns are maximized. And The remuneration is also based on overall return. Overall return means what? Your interest return or dividend return and also the capital appreciation, right? So here the business model consists of both contractual cash flows, that is the cash flows arising out of contract by way of maybe interest, and also by selling those financial assets. Let's have a look at another question. A financial institution holds financial assets to meet liquidity needs. Financial institution, say for example a bank, okay, and it holds financial assets to what? To meet liquidity needs in a stress case scenario. So if at all there is a stress case means what? Suddenly the bank doesn't have money. Suddenly the bank doesn't have money, or it did not receive money that it was expecting to recover from the customers. So there is a stress on the bank, and at that point of time they will use this financial asset to meet the investors demand or to meet the depositors demand. Or sometimes what happens is, suddenly if the depositors start fearing that the bank will collapse, all of them will rush to withdraw the money from the bank. I hope you remember the concept of credit multiplier. Say for example, if somebody deposits 100 rupees to a bank, the bank, let us say after deducting 20% of the reserves requirement, gives a loan of 80 to somebody. That person again comes back and deposits 80 rupees in the bank as deposit. Again out of that 80, the bank will give loan to other parties. This process continues, right? And suddenly if all the depositors want to withdraw the money, the bank may not have money. At that point of time, the bank will use this financial asset to meet the depositors demand, right? So if there is a run on the bank's deposits, the bank will sell this financial asset. The entity does not anticipate selling these assets except in such scenarios. So only scenario is if there is a stress case. The entity monitors the credit quality of the financial assets, and its objective in managing the financial asset is to collect the contractual cash flows. The entity evaluates the performance of the asset on the basis of interest revenue earned and credit losses realized. So basically, what is the intention? Intention is to generate contractual cash flows, collect contractual cash flows. And the performance is also measured based on what? Based on the interest revenue. So if you have generated contractual cash flows and the return is interest revenue, based on that the performance is evaluated. Nowhere is the performance evaluated based on realization or based on, let us say, gains made on appreciation. And sales are also happening only in case of a stress case. Now tell me one thing, will the bank face stress case scenario every day? It will not happen, right? It will happen once in a while. The entity also monitors the fair value of the financial assets from a liquidity perspective to ensure that the cash amount that would be realized if the entity needed to sell the asset in a stress case scenario would be sufficient to meet the entity's liquidity needs. Periodically, the entity makes sales that are insignificant in value to demonstrate liquidity. So, other thing is, the entity monitors fair value. Why? Just to check whether the financial assets would be sufficient to meet the stress case scenario. And sometimes the entity also sells insignificant portions of the financial assets just to test liquidity, just to check whether market is available or not. Evaluate the business model. Now here also if you see, predominantly what is the intention? To collect contractual cash flows. But sir, they want to use the financial asset to meet stress case scenarios. That will happen once in a while. Those are not frequent. Those are infrequent, right? They will not happen regularly. So the intention, the majority part of the business model is to do with collection of contractual cash flows. That is how the business managers are also evaluated, and hence the business model comprises of collecting contractual cash flows from the financial assets. Now, will the classification change if during a previous stress sale they had to sell off a significant amount of financial asset? It will not change, because at the inception when the entity is evaluating the financial asset, they are holding them for collecting contractual cash flows. Now, if let us say the Reserve Bank of India says that okay, every 6 months or every 1 year you have to sell some of the financial assets to check whether the financial assets are liquid or not. Even in that case, the classification will not change, because the intention is to collect contractual cash flows. But now imagine a situation where the entity regularly on a day-to-day basis or on a weekly basis has to sell financial asset to meet liquidity crunch. Then in that case, the intention of the entity to hold this financial asset is to get contractual cash flows as well as to get cash flows from sale of the financial asset. But otherwise, the intention is to collect contractual cash flows only. And one more thing, if there are insignificant sales, see in a portfolio of assets, there may be some sale here, some sale there. If these are insignificant, then again the classification does not change. Here also the business model is to collect contractual cash flows. Let's have a look at another question. An entity has a business model with the objective of originating loans to customers and subsequently selling those loans to a securitization vehicle. So, there is an entity, the business of the entity is to give loans to the customers, and when the loan is given to the customers, the entity has loan receivable. The entity will sell this loan receivable to an entity called securitization vehicle. Vehicle here doesn't mean actual vehicle, it's the designation of an entity. Basically, this entity collects the loan or it buys the loan from the entity, and later on this entity realizes the money from the customers. The securitization vehicle issues instruments to investors. So, whoever has invested in the securitization vehicle, they will get instruments. The originating entity controls the securitization vehicle and consolidates it. So, here in this case, the originating entity, that is the entity which is originating the loan, it controls the securitization vehicle. So, what is happening here is, let us say there is an entity Bajaj Finance, okay, and there are customers. Bajaj Finance gives loans to these customers, right? And intention of Bajaj Finance is not to recover the money from the customers, but to sell these loans. These loans will be sold to a securitization vehicle, which is a different entity. And there are investors, and there are investors in this securitization vehicle, and Bajaj Finance also is an investor in the securitization vehicle, and Bajaj Finance controls the securitization vehicle. Now, when Bajaj Finance controls the securitization vehicle, while preparing financial statements, consolidated financial statements, it will prepare and consolidate the entire group. Now, think of it, these loans, when Bajaj Finance sells these loans to securitization vehicle, these loans are de-recognized, right? Because Bajaj Finance has sold the loans to securitization vehicle, but the securitization vehicle will show these loans in its balance sheet. Now, in the standalone financial statement, Bajaj Finance does not have these loans, okay, because Bajaj Finance has already sold these loans to securitization vehicle. But in the consolidated financial statement, because the loans are still with the securitization vehicle, the loans will be shown in the consolidated financial statements as loan receivable. Now, what is the business model here? If you look at Bajaj Finance, the business model is to sell the financial asset. The business model is not to collect contractual cash flow. And if you look at the securitization vehicle, the intention of holding these assets is to collect contractual cash flows from the customers, because ultimately these customers will pay the amount to this securitization vehicle. But as a group, Bajaj Finance and securitization vehicle, what is the intention? The intention is to collect contractual cash flows from the customers. Okay, so Bajaj Finance in standalone financial statements, the business model is to sell financial asset. In consolidated financial statements, it is to collect contractual cash flow, because the loans are still within the group. Loans have not been sold outside the group. So, that is the business model in standalone financial statements and consolidated financial statements. Now, we have understood what a business model is all about, right? Now, under any business model, there can be two broad objectives. First objective is to collect contractual cash flows only. We have seen examples for that. And the second objective could be to collect contractual cash flows and also to sell the financial asset, right? So, you have to determine what is the business model, what is the intention of the entity. Then, you have to check the characteristic of the contractual cash flow. Now, what is the meaning of contractual cash flow? Basically, the cash flow arising out of a contract. Say for example, I have invested in debentures of a company. It's a financial asset for me. Now, under the contract of debenture, because I have purchased a debenture, I have entered into a contract with the company. Under that contract, I have a contractual right to receive cash flows in form of interest and in form of principal repayments, right? So, that is what is contractual cash flows. Now, what the standard tells us is, whatever is the cash flow, whatever is the contractual cash flow, look at the characteristic of that particular contractual cash flow. Now, what do I mean by that? I gave you an example of debentures where I said there is a contractual cash flow to receive interest and also to receive principal. There can be another contract which is a financial asset, and under the contract I will receive some cash flow. Say for example, I have entered into a future contract. The future contract is favorable, it is in my favor, and hence I have classified it as a financial asset, and under that contract I will receive cash flow. Now the cash flow that I receive under a future contract is not that of a principal or an interest, right, because that is a contractual cash flows arising out of derivative. So what you need to understand is whether the entity receives contractual cash flows which are solely the payments of principal and interest, or there are cash flows other than principal and interest. So two categories: one, only the principal and interest payment, okay, if the cash flow is pertaining to only principal and interest payment. The second category is other cash flows also. So there may be principal, interest and some other kind of cash flows. So that is what we need to understand and determine in the contractual cash flow characteristic. I am repeating once again. First you determine the business model, then you check the characteristic of contractual cash flow. Under the characteristic you will check whether it is only the cash flow related to principal or interest, or it includes other contractual cash flows as well. Now let's take an example of a financial asset again, a debenture, okay, in which the entity has invested. Okay, so you have invested in debenture. Now under the contractual terms of debenture, let us say it's a 5-year debenture, 1, 2, 3, 4, 5, and let's say it's 10,000 debentures and it is quoting at, or the coupon rate is 10%. Now what is the contractual cash flow here? Contractual cash flow here is, let's put the years. In year 1 you will get 1000 of interest, here also 1000 of interest, 1000 of interest, 1000 of interest, and here 10,000 of principal plus 1000 of interest, right? This is what we mean by contractual cash flow, and here the characteristic of contractual cash flow is that of solely principal and interest. There are no other cash flows. Now what do we include in interest? How do we determine what is the interest and how do we determine what is the principal? The standard says you look at a basic lending arrangement. If there is a basic lending arrangement, say for example you go to a bank and you enter into a lending arrangement, what is the principal you would be aware of, what is the interest you would be aware of. Only those things are covered under this term of principal and interest. Sometimes what happens is, say for example there is another category of bond or another kind of bond which is a gold linked bond. Now here whatever are the interest and principal are dependent on prices of gold. So as the price of gold increases, the interest also increases. As the price of gold increases, the redemption also increases, right? So here it is not only the interest and the principal, there is something which is linked to a commodity price of gold. Now here the payments are not solely of principal and interest, because if you enter into a normal borrowing transaction or a normal lending transaction, it will not be linked to the price of a particular commodity. You cannot go to a bank and say that I will borrow a loan and repayment will be based on the gold prices. Will any bank give you that? No bank will give you that, right? So you have to look at a basic lending arrangement, and in that whatever is the principal and interest, only that is covered as a principal and interest repayment. If there are other components like something is linked to the gold prices or something is linked to another commodity prices or something is linked to the performance of the borrower, the condition is that interest is a percentage of profits. Will you have any kind of these terms in case of a normal lending arrangement? You will not have that, right? So such things are not solely principal and interest repayment, right? So when you have to look at solely principal and interest repayment, you have to look at how will these be structured in a basic lending arrangement, okay? If there are other components like linked to commodity prices or linked to the performance of the data, then in such cases, those are not solely principal and interest repayments. Now, what all can come in interest? Let us say, can interest rate be variable? Yes, it of course can be variable, because you can get a floating rate loan in the market. You can go to a bank and borrow in floating rate, right? So interest rate can be variable. Interest rate can vary based on the credit risk. So when you borrow money from the market, or if you are taking home loan or any other personal loan, if your credit score if your credit score is, let us say, low, then your interest will be high. If your credit score is high, your interest will be low. Okay. So, there can be variability based on credit risk, there can be variability based on a floating interest rate, there can be variability based on the profit margin. Some bank may charge higher profit margin, some other bank may charge lower profit margin. Such things are part of your normal interest payment, but something linked to commodity prices, something linked to variability because of the data's performance, or something linked to some kind of future contracts, those are not your basic interest payments, right? So, under the contractual cash flow characteristic test, you need to see whether the contractual cash flows are solely prepayments of principal and interest or they are not. Okay. So, based on this, we will classify financial assets under 3 categories. Now, the next thing that we need to understand is what is this principal? Principal basically is the fair value of the financial asset at initial recognition. Normally, this would be the present value of the cash flows discounted at an appropriate rate. We will understand it subsequently, but please understand principal represents the fair value of the financial asset at initial recognition. So, if there is a debenture and say the coupon is 10%, market rate is 10% and the value of the debentures is 10,000, right, the face value of the debentures, the fair value of the debentures will also be 10,000 because the interest rate and the market rate are same, right. So, this 10,000 represents the principal. And what is interest? Interest basically represents the time value of money. Interest basically represents the time value of money. Interest can include adjustments for liquidity risk, credit risk, it can be variable, okay, but it does not include something which is linked to, let us say, a commodity pricing or something which is a leveraged instrument like in the case of futures and forwards. Before we take up examples on contractual cash flow characteristic test, let us just summarize whatever we have understood so far. First is contractual cash flows that are solely payments of principal and interest on the principal amount outstanding are consistent with a basic lending arrangement. So, if you are saying that there are contractual cash flows which are solely the payments of principal and interest on the principal, they should be consistent with what? They should be consistent with a basic lending arrangement. Principal, as we have understood, is the fair value of the financial asset at initial recognition, and interest will include what all? Interest will include, in a basic lending arrangement, if you look at, interest will include consideration for the time value of money, credit risk, also other basic lending risk like liquidity risk. Sometimes interest may include cost. What kind of cost are we talking about? Say for example, you take a loan against gold. So, you give the gold to the banker and against that gold you take a loan. Now, when you deposit the gold with the banker or any other money lender, that gold has to be kept in a secure place. Maybe the lender or the bank has to keep a designated, secured, safe place where you will be keeping the gold, right. So, there will be cost involved in that. You will have to keep securities, surveillance and all of that. So, there will be cost involved with that. So, such cost may also be included in the interest. And profit margin that is consistent with a basic lending arrangement. So, whenever you lend, obviously you want some basic profit margin, right. So, even that is a part of your interest thing. So, we have to clearly identify whether the contractual cash flows are solely the payment of principal and interest. So, if they are solely the payment of principal and interest, then it will fall under one category. If they are not solely the payment of principal and interest, then it will fall under some other category. So, now let us have a look at few examples and understand the contractual cash flow characteristic test. Instrument A is a bond with stated maturity date. So, it is a bond and it has a maturity date. Payments of principal and interest on the principal amount. So, there are principal and interest on principal. Interest on principal are linked to an inflation index of the currency in which the instrument is issued. So, the interest payment as well as the principal repayment are linked to what? They are linked to the inflation index. Means if inflation goes up, the repayment will be higher, the interest also will be higher. Please remember, this is not linked to some commodity or performance. It is purely based on inflation. And what happens is, if you link something to inflation, what you get is the real income or real interest. Okay. So, if something is linked to interest, if interest are linked to inflation rates or if the principal is linked to inflation rates, what you get back is the real money. For example, today if you have 1000 rupees, okay, and you invest in the bank and you get 4% rate of interest, after 1 year you get back 1000 plus 40 rupees of interest, 1040. In the meanwhile, let's say the inflation is 8%. So, something costing 1000 today will cost 1080 after 1 year. So, you have lost money there. Though you have earned interest, you have lost money there, right? So, if the interest was linked to inflation, let us say instead of 4%, the bank also paid you 8%, then you got the real money back, right? So, that is what is the meaning of linking to inflation rate. The inflation link is not leveraged. Always remember, if something is leveraged, for example, in case of a future contract or a forward contract or a derivative contract, if something is leveraged, we took the example of Reliance, right? Where when you purchase physically, you have to pay a higher amount. When you enter into a forward contract, you have to pay a lower amount. So there you get a higher benefit by investing a lower amount, which is basically the leverage benefit. And in cases where there is a leverage, the losses also can be higher. So here it says inflation link is not leveraged. If it is leveraged, then you cannot consider the leveraged part to be the repayment of principal and interest only. And the principal is protected. So inflation link is not leveraged and the principal is also protected. So evaluate the contractual cash flows characteristic test. So here, as I explained it to you, that the contractual cash flow is linked to inflation index. What you are getting is the real interest and the real principal, and hence the cash flows are solely the repayment of principal and interest only. Okay, but if it was a leverage thing, then it would not be solely repayment of principal and interest. So let's look at the answer. The contractual cash flows are solely payments of principal and interest. Basically, it means it is only the payment of principal and interest. There is no other angle coming into place. Linking of payments of principal and interest to an unleveraged inflation index resets the time value of money to a current level. Basically, we are resetting the time value of money based on the inflation. And always remember, when we talk about economics and all, inflation and interest rates are closely related to one another. In other words, the interest rate on the instrument reflects real interest. So when you reset the interest rate, it reflects the real interest. Thus, the interest amounts are consideration for the time value of money on the principal amount outstanding. So here, interest is representing the time value of money on the principal amount outstanding. Though it is linked to an inflation index, it is still giving us real interest and it is still giving us the time value of money. However, if the interest payments were indexed to another variable such as debtor's performance, income of the debtor, or an equity index which cannot be predicted, or maybe a commodity price, then the contractual cash flows are not payments of principal and interest on the principal amount outstanding. So, if it is linked to something else like a debtor's performance or commodity prices and all, then the contractual cash flows do not solely represent the repayment of principal and interest. Another angle to it is, if you index it to a debtor's performance and that indexing takes care of the credit rating. For example, the income of the debtor increases, the credit rating also improves and the interest rate would automatically go down. If that is the case, then it will be the payment of interest and principal. So in that case, we can consider if the linking of the interest to the debtor's performance is taking care of the credit risk related aspect. Right, but in other cases it cannot be considered to be the contractual cash flow which is repayment of principal and interest only. So in these kind of questions you have to check whether the contractual cash flow represent a basic lending arrangement. If they represent a basic lending arrangement where you get interest and principal, then the contractual cash flow have the characteristic of solely payment of interest and principal, right. Now here, even though it is linked to inflation, it is still considered to be the payment of interest and principal only. Let's look at another example. Instrument F is a bond that is convertible into a fixed number of equity instruments of the issuer. Now here, instrument F is a bond. You have a bond that is convertible into a fixed number of equity instruments. Now here, what is the contract giving us? Is the contract giving us cash flows? It is not giving us cash flows. It is giving us equity. You may sell the equity and get money, but is there a contractual cash flow which is flowing into the entity? It is not, right? So when you invest into the instrument F, what you will get subsequently is equity instrument. The value of that is not fixed, first thing. Secondly, there is no contractual cash flow which is a payment of interest and the principal, right? Because what you are getting ultimately is the equity instrument of the issuer, and hence here the cash flow characteristic, if you look at it, they are not payment of principal and interest. Then instrument H is a perpetual instrument, but the issuer may call the instrument at any point and pay the holder the par amount plus accrued interest due. Instrument H pays a market interest rate, but the payment of interest cannot be made unless the issuer is able to remain solvent immediately afterwards. Deferred interest does not accrue additional interest. Analyze the nature of cash flow. So here there is a situation where there is a perpetual instrument. Okay, perpetual instrument means what? It will not be redeemed. That is the first thing. Second, the issuer may call the instrument, means the issuer may redeem the instrument at any point of time and pay the par amount plus accrued interest due. But the interest payment cannot be made unless the issuer is able to remain solvent immediately afterwards. Meaning to say, here the interest receivable or the amount of interest that the investor will receive depends on whether the other party will remain solvent or not subsequently, right? And if the entity is unable to pay the interest will be deferred, but the investor will not earn any interest on the deferred interest. Meaning to say, you will not get interest on interest. For example, if you have invested 10,000, first year interest is 1,000, 10%. Okay, first year interest is 1,000. If this 1,000 is not paid in the first year, you will get the amount in the second year, but in the second year, you will not get any interest on the interest outstanding of the first year. So, 10,000 interest outstanding in the first year is 1,000, that is not paid. That 1,000 will be paid subsequently without any interest on interest. In normal circumstances, if 10,000 is the principal amount, 10% interest is for the first year, that is 1,000. Second year you will get interest on 10,000 plus 1,000, 11,000, right? In that case you are getting the time value of money. But in this case, because you are not getting any interest on the deferred interest, it does not completely compensate the time value of money, which is a feature of a basic lending arrangement, right? So, if I have to just, explain you in numbers, principal is, let's say, 10,000, interest for year 1 is 1,000, right? And this is not paid. So, interest in year 2 should be on 10% of 11,000. If this is the case, then you are getting compensated for time value of money. But here it is saying that the deferred interest does not accrue additional interest. So, because it does not accrue additional interest, it is not compensating you for the time value of money, and hence this instrument is not solely payment of interest and principal as per the standards. Instrument D is a loan with recourse and is secured by collateral. Does the collateral affect the nature of contractual cash flow? See, what is the collateral all about? Collateral gives you some form of security. You are secured that, okay, at the end you will get the repayment back, right? But just having a collateral does not change the cash flow characteristics. See, cash flow is whether you are getting principal and interest. The cash flow characteristic test talks about whether you are getting principal and interest. You may have a security, it may be a secured loan that just gives you a comfort, that just gives you a protection, but it does not change the characteristic of the cash flows. So here the collateral does not affect the characteristic of contractual cash flows. Then instrument G is a loan that pays an inverse floating interest rate, that is, the interest rate has an inverse relationship to the market interest rate. Analyze the nature of cash flow. Now, this is a case we are talking about. Say there is an entity, there is a bank, the entity has borrowed money from the bank. The payment of interest is based on a rate that is inversely related to the market interest rate. So, if the market interest rate goes up, the interest rate under the loan comes down. If the market interest rate goes down, the interest under the loan goes up. Now, do you find these kind of scenarios in a actual lending arrangement? If you go to a bank and say that I will pay you lower interest rate, if the interest rate is going up, will the bank agree? The bank will not agree, right? So here the cash flows do not reflect the payment of interest and principal, because in a basic lending arrangement you will have interest rates going up if the market interest rates goes up. Okay, I have not seen a bank which says that, okay, if the interest rate goes up, I will collect less rate of interest, and if the interest rate goes down, I will collect high rate of interest, right? You will not find that in a basic lending arrangement. So basically, under a contractual cash flow characteristic test, you have to see whether the contractual cash flow, they reflect the repayment of principal and interest on principal outstanding. Okay, if they are solely reflecting that, then we have a particular kind of classification. If they do not reflect that, then we have another kind of classification. So to summarize this entire discussion, what you need to see, you have to check the business model, you have to check the intention. What is the intention? Whether it is to get contractual cash flows, or whether it is to get contractual cash flows and also to sell the asset, right? That is first you have to check. And secondly, when it comes to contractual cash flow, you have to check whether the contractual cash flows represent principal payment and interest on principal outstanding, or they represent something else. So now, based on the business model test and the contractual cash flow characteristic test, we will classify financial assets as financial assets measured at amortized cost, fair value through other comprehensive income, or fair value through P&L. These are the three categorization based on the business model test and contractual cash flow characteristic test. Now first we'll understand what do we mean by financial assets measured at amortized cost. Please remember, initial recognition is at fair value only. Okay, there will be some adjustments to transaction price and all of that, we'll understand that, but generally, initial recognition is at fair value. Subsequent recognition is done using either amortized cost, fair value through OCI, or fair value through P&L. So first let us understand how do we measure financial assets using the amortized cost method. Now, what is the meaning of measuring a financial asset at amortized cost? I'll give a very simple example. We have done similar things when we did government grants, when we did leases also. The principle remains the same. Amortized cost is basically applying the effective interest rate method. So say for example, there is a debenture. Okay, the entity has invested into the debenture. These are not issued. Okay, there is a debenture in which the entity has invested in debentures of another entity. Now, when you have invested in debentures of another entity, you have a contractual right to receive cash. That's why it is a financial asset, right? So, assume face value of it, this is 1 lakh and interest rate coupon is, let us say, 10% and market interest rate is, let us say, for example, 9%. Okay, so the debenture gives me an interest of 10%, but if I give the same money in the market, if I invest the same money in the market, the interest that I will earn is only 9%. And if there is an instrument which gives us a higher interest rate, obviously it will be valued more than the face value. Okay, so if I have an instrument which is giving me 10%, whereas the market rate is 9%, obviously the value will be higher. And assume for a moment this is for a tenure of 4 years. I am keeping it short so that we can quickly understand the example, move on to the conditions, right? Now, if I have to ask you a question, is this 1 lakh the fair value of the instrument? Obviously no, because it is giving me better returns than the market. So, it is not the fair value and nobody will sell me this instrument at 1 lakh because its fair value will be higher. What is the fair value? Now, here, how will I determine the fair value? It is basically the present value of the future cash flows, right? Now, what are the cash flows here? Here, cash flow amount. So, year 1, 2, 3, 4, cash flow is of interest, here it is interest plus principal, right? What is the cash flow? 1 lakh, what is the cash flow? 10% on 1 lakh, that is what you will get. So, that will be 10,000, 10,000 here, 10,000 here, and here you will get 1 lakh, 10,000. Now, for this, we will calculate what is the present value factor at 9%. Why at 9%? Because the market yield is 9%. So, 1 divided by 1.09 first year, then this divided by 1.09 second year, third year and the fourth year. What is the present value? Present value will be 10,000 multiplied by this 1, 2, 3, 4. Simple calculations, I have all done it. So, the present value is 1,03,239. Typically, in the market, this bond or this debenture will be available at 1,03,239. Nobody would be selling it at a lesser price than that. Okay. And for now, we are ignoring all the other costs, transaction cost and all of that. This is the amount that the entity would be paying. So, you will pay 1,03,239. That becomes the cost of your investment, right? And if this financial asset falls in the category of measuring at amortized cost, you will initially recognize it at fair value. This is the number, and subsequently you will measure this using the effective interest method. What is this effective interest method? Simply put, we have 1, 2, 3, 4 years. What is the opening balance? interest at 9%, amount received and closing balance, right. So, opening balance is your cost 103,239, interest at 9%, this multiplied by 9%, you get 9292.57, amount received 10,000, that is what you will receive, closing balance is opening plus interest minus received, that is 10,000. Then opening balance, interest, amount received, closing balance. So, you do it for each period. Here you will get 1,10,000, closing balance will be 0. So, basically recognizing it initially at the cost and applying the effective interest rate method is nothing but the amortized cost method. So, basically what are we doing here? Initially we are taking the cost of the instrument and whatever are the cash flows and whatever is the subsequent repayment amount, the differences between initial investment and the future cash flows, that is being amortized. Now, amortized here not only means depreciation, amortized also means accounting for the difference in amount you have paid and the amount you have received. For example, here amount you have paid is 1,03,239, amount that is received is all of these put together 1,40,000. The difference between these two have to be amortized over the life of the instrument, right? That is what is called the amortized cost method. So, what is amortized cost? Amortized cost is the amount at which the financial asset is measured at initial recognition. So, amount at which you measure it at initial recognition minus any principal repayments. So, you have to reduce that, plus or minus the cumulative amortization using the effective interest method of any difference between the initial amount and the maturity amount, right. So that is what is the amortized cost. So, basically what you do, you take the amount at which it is measured initially. If there are any principal repayments, you will reduce it and you will use the effective interest method to amortize the difference between the initial investment and the amounts that you would receive, right. That is what is called the amortized cost method. Simply put, it is the method by which you account for interest using the effective interest method. Now, this is the case of a debenture. What happens in case of an account receivable? Let us say you have sold goods. In that also, do we recognize interest like this? See, for the purpose of recognizing account receivables, you will have to refer to Ind AS 115. Okay, so that will not be recognized using this particular fair value method. You will recognize based on Ind AS 115. If there are any interest component involved, if there are any loss allowance involved, then you will refer to financial instruments, right. So, largely you will use this effective interest method when you have investments in, let's say, bonds, debentures or any other kind of receivable, like let's say lease receivable. There also you are applying the similar concept. So, the first condition is financial asset is held within a business model. So, within a business model there is a financial asset whose objective is to hold financial assets in order to collect the contractual cash flows. So, if you remember, under the business model test, we have understood that the objective can be to collect contractual cash flows, or the objective can be to collect contractual cash flows and also to sell the financial asset. Now, here if you are measuring something at amortized cost, the second part, selling the financial asset, should not be there. It only has to be to collect the contractual cash flows, and the contractual terms gives rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. So, the contractual terms tells us that okay, on so and so dates you will receive cash flows, and those cash flows are what? They are solely payments of the principal amount and interest on principal outstanding. If there is any other payment involved, then this condition is not met. So, please remember, it has to meet this thing, which is a solely payments of principal and interest. So, the cash flow should only represent payments of principal and interest. And what should be the objective? The objective should be to hold the assets in order to collect the contractual cash flows. So, to summarize, there is a business model. The objective is to collect contractual cash flows, and these contractual cash flows are payments of principal and interest only. They are solely the payments of principal and interest on principal outstanding. If these two conditions are met, then you will measure the financial asset at amortized cost. Now, the logic for accounting this at amortized cost is because the intention is to just to collect the cash flows. There is no intention to make gains because of fair value fluctuations or market value fluctuations. If you remember, in the beginning I gave an example that I have invested in bonds and my intention is to collect the cash flows of interest and principal. Whereas when you have invested in bonds, your intention is to take advantage of market value fluctuation. Now tell me, if you have to take advantage of market value fluctuation, if you want to sell the financial asset, if that is the intention, can I classify it at amortized cost? I cannot, because the first condition is not met. So the first condition is that the business model should have an objective to collect the contractual cash flows, and second thing is the contractual cash flows should be of principal and interest only. There cannot be cash flows which represent any other item, right? If these two conditions are satisfied, then the financial asset will be measured at amortized cost. Now, based on the two conditions that we just discussed, one is the business model test where the entity's objective is to collect cash flows, right? So we call it hold to collect, means you are holding the financial asset to collect the contractual cash flows. And second, the contractual cash flows should be solely the payment of principal and interest, that is SPPI, solely the payment of principal and interest. If these two conditions are satisfied, we classify financial asset as measured at amortized cost, right? So let's have a look at a few questions. An entity purchased a debt instrument for 1 lakh. The instrument pays interest of 6,000 annually and has 10 years to maturity when purchased. The entity intends to hold the asset to collect contractual cash flows. Evaluate the business model test. Now here we need to see whether the business model test of hold to collect the contractual cash flows is that met or not. So here it says that the entity purchased a debt instrument for 1 lakh. Okay, instrument pays interest of 6,000 and has 10 years to maturity, and the entity intends to hold the asset to collect the contractual cash flows. So the question itself says that the entity wants to hold the instrument to collect the contractual cash flows. What are the two contractual cash flows here? The principal repayment after 10 years and the annual interest of 6,000. Hence, the hold to collect business model test is satisfied and the first condition would be fulfilled, right? Then let's look at the next one. The first part of the question is same, or the example is same. The entity intends to hold the asset to collect the contractual cash flow. We call it hold to collect test. Then 6 years have passed and the entity is suffering a liquidity crisis and needs to sell the asset to raise the funds. Evaluate the business model. Now, initially when we purchased the asset, we purchased it with the intention to hold it till maturity, to hold it to collect the cash flows. 6 years after that is 6 years after initially recognizing, the entity is facing liquidity crisis. Now when the entity is facing liquidity crisis, it wants to sell off the financial asset. Now the question is, how will we evaluate the business model test? Now friends, when we have to classify financial assets, you have to look at the inception. At the inception, what was the intention? What was the business model? The business model was to hold the financial asset to collect the contractual cash flows. So if that was the business model at inception, means the entity wants to hold the financial asset to collect the contractual cash flows, then it will meet the hold to collect criteria or hold to collect test. Subsequently, after 6 years, we are selling it off. Will it change my assessment at the inception? It will not change my assessment at the inception. So it will continue to satisfy the criteria or the test of hold to collect the contractual cash flows. Subsequently, selling because of financial crisis does not change the classification done at inception. So basically, the sale of financial asset was not expected on initial classification and does not affect the classification. That is, there is no retrospective reclassification. Moving on, the next question. Parent H Limited provides a loan to its subsidiary S Limited. The loan is classified as current liability in subsidiary's S financial statement and has the following terms: interest free, no fixed repayment terms, repayable on demand. Does the loan meet the SPPI or contractual cash flow characteristic test? So basically, does the payment here reflect solely the payment of principal and interest? Yes, because there is nothing else being paid. Okay, whatever is being paid is the repayment of principal, and yes, there will be a implied component of interest, which we will understand subsequently when we do the accounting part of it, right? So here, even though it's an interest free loan, the repayment part is only the payment of principal and interest on principal outstanding, and hence that criteria is met. Then entity A lends entity B 5 million for 10 years subject to the following terms. Interest is based on prevailing variable market interest rate. variable interest rate is capped at 10%, repayable in 10 years. Does the loan meet the SPPI or contractual cash flow characteristic test? So now again here there is a loan and the interest on that loan is variable. Now we have understood that the interest on a loan can be a variable interest payment. So this will satisfy the criteria of solely payment of principal and interest. Then H Limited makes sale of goods to customers on credit of 60 days. The customers are entitled to earn a cash discount at 5% if payment is made before 60 days and interest at 12% is charged for any payments made after 60 days. Company does not have policy of selling its debtors and holds them to collect the contractual cash flows. Evaluate the financial instrument. Now here there is a company, there is an entity and there are customers. If the customers pay within a specified period of time, 5% discount is given. So this is like a negative interest, okay, and if they delay beyond that, they will be charged an interest of 12% per annum. Now here what does the cash flow comprise of? The cash flow comprises of the principal payment and interest on the principal outstanding, right? There are no other contractual cash flows. Hence, this meets the SPPI test. Now, the first one where we said that there is a 5% per annum discount, that discount represents a negative interest kind of a scenario. Okay. So, here S Limited has a contractual right to receive cash flows from its customers and therefore, such trade receivables are financial assets. This we know. Further, the business model test to collect will satisfy. Objective is to hold its trade receivable to collect the contractual cash flows and the contractual cash flows are solely payments of principal and interest if paid beyond the credit period. Hence, such trade receivables are classified as measured at amortized cost. How to do the measurement, how to factor in the discount and all of that, the bad debts part, all of that will come subsequently. But here, please understand, even account receivable would satisfy these two criteria and hence, they would be classified as measured at amortized cost. Next one. A Limited, the company, has obtained the premises from B Limited on lease to carry its business. The lease contract period is 5 years. As per the lease agreement, A Limited has paid security deposits to B Limited amounting to 10 lakh, which is refundable after the expiry of the lease agreement. Now here, A Limited has obtained the premises on lease, so A Limited has paid the deposit. How would such deposit be treated in the books of A Limited? Now again here, when A Limited has given the deposits, will that deposit come back after the specified period of time? Yes. Is it solely the payment of principal? Yes. Does it meet the criteria of financial asset? Yes, because there is a contractual right to receive cash. Is the business model to hold till maturity? Yes, you have to hold till maturity. You will not, selling it off. You will not sell off the deposit to somebody else. And ultimately, what will you collect? You will collect the deposit amount. You will collect the principal portion. Hence, this meets the criteria of solely payment of principal and interest. Hence, such security deposits would be classified as financial assets measured at amortized cost. Now friends, if you have seen all of these examples, most of these pertain to loan given, trade receivables, deposits made, right? These are the kind of financial assets which would fit in the category of financial assets measured at amortized cost. Let's have a look at another question. A Limited, the company, has obtained the premises from B Limited on lease to carry on its business. So, A has taken the premises on lease. So, the lease transaction will be covered by Ind AS 116. Okay. The lease contract period is 5 years and as per the lease agreement, A Limited has paid security deposits to B Limited amounting to rupees 10 lakhs, which is refundable after the expiry of lease agreement. How should the deposits be treated in the books of A Limited? Now, here, whenever you take a premise on lease, the landlord or the owner, the lessor basically, they will ask for some kind of deposit so that you pay rent on time, or if you run away the other day, they can use the deposit and they can recover the rental part. Now, when will we get back the deposit? We will get back the deposit after 5 years, right? So, there is a contractual right to receive deposits after 5 years. So, what kind of asset is it? It is a financial asset because there is a contractual right to receive cash after 5 years. Now, whether this financial asset should be classified as measured at amortized cost or not, for that we have to check whether the cash flows are solely the payment of principal and interest. Now here if you see there is a security deposit which has been paid rupees 10 lakhs. Generally these kind of deposits do not carry any interest. They do not carry any interest. What happens is you pay 10 lakhs today, after 5 years you will get back the 10 lakhs. So here the cash flow that you are getting back, if you look at it from a normal parlance, you will say that okay, I gave 10 lakhs and I am getting back the 10 lakhs. But when you account for these security deposit as financial asset, what you need to do is you need to determine the fair value of the deposit today. So here what you do is, we'll understand this measurement aspect subsequently also, but for your understanding, what you do is, if I were to receive 10 lakhs after 5 years, how much amount would I have given today? Okay, that becomes the fair value of the deposit. So you will account for that deposit at that fair value, and you'll keep on adding interest over a period of time, and subsequently at the end of 5 years you will get the 10 lakhs back, right? So the 10 lakhs that you are getting back is solely the payment of principal and interest, right? So when we account for deposits, you will not say that 10 lakh is the deposit made today. You will only take the present value of that 10 lakhs today to call it a deposit. Remaining part will be your interest income. So now you may have a question, sir, we gave 10 lakhs and assume for a moment 7 lakhs is the fair value. 7 lakhs is the fair value or the present value of that deposit. So what do we do with the balance 3 lakhs? Balance 3 lakhs will be considered as prepayment of lease rentals as per Ind AS 116. So basically when you pay 10 lakhs today, you will say 7 lakh is towards deposit. Over that I will keep on accruing interest, and at the end of 5 years I will receive 10 lakhs. The extra 3 lakhs that I am paying today, that is nothing but a kind of a prepaid rent or lease payments made in advance, and that 3 lakhs will be taken to Ind AS 116 and you will account for it there, right? So here this 10 lakhs is repayment of principal and interest, and it is solely the payment of principal and interest. You do not go in the market and you sell the deposit, right? The intention would not be to sell the deposit or sell the financial asset and collect cash. So the business model test is to collect the principal and the interest, and the contractual cash flow test also is solely the payment of principal and interest, right? So in this case you will measure it as financial asset measured at amortized cost. In the above case, since A Limited has a contractual right to receive cash flows and therefore such security deposits are receivable, they are financial assets. Further, A Limited business model test to collect will be satisfied as the objective is to hold its security deposit receivable to collect contractual cash flows till the end of maturity period. And these receivable recorded in the books represent contractual cash flows that are solely payment of principal and interest. See, for now, see this aspect of breaking it down into principal and interest, all of that we will understand when we move on to the measurement part. For now, what you need to understand is the contractual cash flow characteristic test. If you look at, the cash flows are solely the payment of principal and interest on principal outstanding. So where is the interest here? We will have to calculate the implied fair value, and based on that we will be calculating the interest. Hence, as security deposits receivables are classified at amortized cost. So to summarize once again, financial asset measured at amortized cost, the two conditions that must be satisfied are, the first one, the business model test, that is the asset is held within a business model whose objective is to hold the financial asset in order to collect contractual cash flows, and contractual terms. See, please remember the contractual terms, the terms of the contract give rise on specified dates to cash flows that are solely, meaning to say they are only payments of principal and interest on the principal amount outstanding. So under the contract, you will get only what? You will get only the principal and interest. If you get something else also in the contract, then this condition will not be satisfied. Something else means, let us say the refund of the deposit is dependent on the increase in the real estate prices. If some condition like that is given, then those are not solely the payments of principal and interest. There is another component involved there, and hence the amortized cost method cannot be used, or you will not classify the financial assets measured at amortized cost. Very, very important. Please ensure that you remember the classification criteria, because once you remember these, the measurement, the recording part, the accounting part is much simpler, and most of the financial assets would fall into this category, and this is one thing which would be tested frequently in the examination as well, right? So the first category in which you classify the financial asset is financial assets measured at amortized cost. Now, say for a moment we have invested in equity shares of Reliance Industries. Now, when we invest in equity instruments, what are these equity instruments? These are financial assets for us, right? Because we are holding the equity instruments. Now, when I have invested in shares of Reliance Industries, what is my intention? Is my intention to collect contractual cash flows? Now, first thing we have to check is whether there are contractual cash flows or not. Now, when I make investments in equity, are there any contractual cash flows? Did Reliance Industries tell me that they will pay me dividend every year, so much of fixed amount, or did they tell me that they will repay back the amount invested after some point of time? They have not told that. Equity is something which will be paid at the last, right? So here there are no contractual cash flows. When I am making investments in equity instrument of another entity, there are no contractual cash flows. So the business model cannot be to collect contractual cash flows, and hence you cannot classify equity investments or equity instruments as financial assets measured at amortized cost. Why? Because there are no contractual cash flows. So the business model test also fails, and the intention of holding equity instruments would be to collect or to make gains or maybe to collect dividends, but then there is no contractual cash flows. Because there is no contractual cash flows, investments in equity instruments can never be measured at amortized cost. You may receive dividend, but again that is not contractual dividend which is being paid, right? So investments in equity instruments, when you hold them as financial assets, can never be measured using amortized cost method. And again, once again, for the sake of repetition, whenever you have to check financial assets whether they can be measured at amortized cost or not, you have to check whether the contractual cash flows are solely the payment of principal and interest, and the business model is to hold the financial asset with the objective of collecting only the contractual cash flows. Now with this understanding, let us move on to the next classification, which is financial assets measured as fair value through other comprehensive income. We call it FVTOCI or FVOCI, fair value through other comprehensive income. Now when you look at this term fair value, one thing is very clear, that you will measure those financial assets at fair value. But sir, you also told that financial assets would be measured at fair value at initial recognition. That is at initial recognition. At initial recognition, it is always at fair value. When we say fair value through other comprehensive income, these financial assets will subsequently also be measured at fair value. Now what is the meaning of through other comprehensive income? It means that whatever is the gain or loss because of fair valuation, you will take that gain or loss and it will be accumulated under OCI. And once the financial asset is disposed, this will be reclassified into retained earnings. We will come to that subsequently, but for now understand, fair value through other comprehensive income means you will do the fair valuation, and using that fair valuation, whatever is the gain or loss, that will be accumulated in other comprehensive income. That is how the name comes, FVTOCI. Now what are the conditions for this? Now here the conditions are pretty much similar to the first one, but there is an additional condition. What is the additional condition? The business model should be to hold the financial assets with an objective of collecting contractual cash flows and selling the financial assets. So the business model's objective is what? To collect the contractual cash flows, means we will collect the contractual cash flows, we will enjoy the interest, we will enjoy the principal. But whenever there is an opportunity, whenever we see some kind of gain, then at that point of time, these financial assets would be sold off. So the objective is not only to collect contractual cash flows, but also to sell financial assets. And the second condition is same as the earlier one. What is the second condition? The second condition is that the contractual cash flows are solely the payment of principal and interest. So almost everything is same, just that you are collecting contractual cash flows and also you may sell the financial asset to realize the cash flows, right? So the objective is to collect the contractual cash flows like interest and principal, and to sell the financial asset, that is the second part of it. And the second condition is again, the contractual cash flows should be solely the payment of principal and interest on principal outstanding. If there are any other contractual cash flows, then you will not be able to measure them as fair value through other comprehensive income. Now we have understood what are financial assets measured at amortized cost and financial asset measured at fair value through other comprehensive income. The third category, which is also the residual category, is fair value through P&L. Now what does this category mean? This category takes care of all other financial assets. So something which does not fit into amortized cost, something which does not fit into FVTOCI, that will go to FVTPL, that is fair value through P&L, right? So for example, if you have invested in shares of another company, now that will not be measured at amortized cost. That will also not be measured at fair value through OCI. Of course, there is a small exception that I will come to it separately, but generally you will not measure it at fair value through other comprehensive income. So you will put that under residual category, which is fair value through P&L. Similarly, say for example, derivative instruments. Now, under a derivative instruments, will an entity have contractual right to receive cash flow which are solely principal and interest? They will not have that right, correct? So, that cannot be measured as amortized cost, that cannot be measured as fair value through other comprehensive income. So, you will put derivative instruments also under the third category, that is fair value through P&L, right? So, whichever instrument does not fit into the amortized cost or FVT OCI, you will measure them as fair value through P&L. As I told you earlier, there is a small exception which you will understand subsequently, but first you have to be clear with the categorization. Just to quickly revise, under amortized cost, the business model should be to collect the contractual cash flows, and the contractual cash flows should be solely the payment of principal and interest. That is the first category. For FVT OCI, the business model should be to collect contractual cash flows and to sell the financial asset, and the contractual cash flows should be solely the payment of principal and interest. And the last category is the residual category. Whichever does not fit into the first and second category, you will measure them as fair value through P&L, right? So, now we have understood the classification. We will talk about the exception and then we will move on to measurement. Once we do measurement, you will understand that if you have understood everything logically, the financial instruments topic as such is not so scary as it sounds. Now, before we go into the exception of classifying financial asset, let us understand one key term, that is held for trading. Now, what is this held for trading? The term itself suggests that you hold the financial assets for trading purposes. Trading involves frequently buying and selling. You buy today, after 2 days the prices go up, you sell, then again you wait for the prices to come down, then again you buy, then again you sell, right? So, when you have a lot of trading activities, that is buying and selling of financial assets, those financial assets are called financial assets which are held for trading, right? If a financial asset is held for trading, then what is the intention? What is the business model? Business model is to make short-term profits. The objective of the business model is to make short-term profits or short-term gains by frequently buying and selling. And if a financial asset is held for trading purpose, will you classify it as measured at amortized cost? You cannot, because there is already an intention to buy and sell. Will you classify it as fair value through OCI? Even you will not do it here, because the primary intention is to make profits through short-term gains, right? The interest income that you will get for this, for the 2 to 3 day period holding or maybe 10 to 15 days of holding is incidental, right? Business model is such that you want to make gains by frequently buying and selling the financial assets. So, financial assets which are held for trading purposes, those will always be classified or measured as fair value through P&L. So, if there is a bond in which you have invested and the objective is to make short-term gains through price movements, then that will be your fair value through P&L. You will not classify it as amortized cost or fair value through OCI. Any financial asset which is held for trading purpose will be classified under fair value through P&L. Now, we have understood the classification of financial asset, and we have understood 3 categories: measured at amortized cost, fair value through other comprehensive income, and fair value through P&L. Now, there are 2 exceptions that we need to understand. The first one is, if it is a financial asset which can either be under the amortized cost category or FVT OCI category, if it falls under these 2 categories, the entity may choose to designate it as fair value through P&L at inception, and this option is irrevocable. Meaning to say, if the entity believes that to avoid some kind of accounting mismatch, it needs to classify these financial assets as financial assets measured at fair value through P&L, it can do that. This option has to be chosen at the time of initial recognition at inception, and it is irrevocable. So, say for example, if there is a financial asset which can be classified as fair value through OCI and the entity chooses to measure it at FVTPL, can it do so? Yes, it can do so, but it is an irrevocable option. Means once you have taken that choice, you cannot change the choice again, and it has to be done by instrument basis. It is not an accounting policy as such, right? So, if the entity wants to make the accounting easier, to avoid some accounting mismatch, then it can classify those assets as FVTPL. Now, this could be done in cases where the entity holds a financial asset and that financial asset is linked to another item which impacts the P&L. If that happens, then the entity would want to classify the financial asset also as fair value through P&L. Now, to give you a broad example, say this entity we are talking about has made some foreign currency loans. It has given loan to a foreign entity. Okay. Now, there is a foreign currency loan which is a financial asset which is solely the collection of principal and interest. That is the whole purpose. The contractual cash flows, mandate that, and it is in a foreign currency. Now, to safeguard or to hedge that particular foreign currency loan, the entity has entered into a derivative contract. Now, this derivative contract is something which will be measured as fair value through P&L, whereas there is another item which is measured at amortized cost. So, this may lead to accounting mismatch. You will understand it subsequently when we learn about hedging and all of that. This may lead to an accounting mismatch where the derivative gain and loss is going to P&L, and for this financial asset you are using some other method to measure the to measure the income and to measure the financial asset. So, to avoid such scenarios, the entity may say that okay, this loan also we will classify it as fair value through P&L at inception, and this is an irrevocable choice, right? That is the first exception. The second exception is with respect to equity instruments. Now, tell me one thing, how will you measure equity instruments which are financial asset? Say, I have invested in shares of one company. How will I measure those shares? Under which category will I classify that? Can I classify it as amortized cost? No. Can I classify it as fair value through OCI? No, because there is no contractual cash flow involved. So, only category left is fair value through P&L. Now, considering practical situations where there could be a lot of fluctuation in the share price of a company, the entity may not want to have so much of fluctuation in its P&L on a year-to-year basis. So, the entity believes that this equity instrument, I am anyways holding it for a long period of time. I am not bothered about much of day-to-day fluctuations. Unnecessarily, my P&L is getting impacted because one day the share price goes up, the other day the share price comes down. Sometimes it keeps on going and suddenly it falls, and it is impacting my P&L unnecessarily. So, here the standard says, don't worry, if you have financial assets which are equity instruments and you do not want your P&L to be impacted, we have an option for you. But please remember, this option is irrevocable. You cannot change the option later. Okay, what is the option? The option is, instead of classifying it as fair value through P&L, you can classify it as fair value through OCI. Okay, so I am saved. My P&L will not get impacted. What will get impacted? Directly the other comprehensive income. So, you are happy. You say, okay, my P&L is saved now. So, I will classify these equity instruments as fair value through other comprehensive income. And later on, when I sell it off, I will take it to P&L. The standard says, wait. If you are classifying that equity instrument under fair value through OCI, then when you sell it also, you cannot take the income to your P&L. Means, when you are choosing it, be very careful while choosing the option. The day-to-day fluctuations will not impact your P&L. But the ultimate gain in the future when you sell it to somebody, even that cannot be taken to P&L. That will never be taken to P&L. So, from OCI, the gain or loss when you dispose of the financial asset cannot be reclassified into P&L. So, that is the risk also you are taking. Means, you cannot show a higher profit in the year in which you sell. So, the summary of the discussion is, if the entity has financial assets which are equity instruments of another entity, the entity can choose to classify them as fair value through other comprehensive income. Please remember, this is an irrevocable decision. You can, and the gain or loss will be accumulated in OCI. And in future, even when you dispose of the financial asset, you cannot reclassify the gain from OCI to P&L. So, that is the choice what the entity has. So, two exceptions we talked about. First exception is something which can be measured under amortized cost or fair value through OCI, that can be measured as fair value through P&L. It is also an irrevocable choice. The second is equity instruments which are not held for trading. Please always remember, if something is held for trading, it always will be classified as fair value through P&L. So, if there are equity instruments, say for example, investments in subsidiaries which you would not trade on a day-to-day basis, which you would not trade, right? So, such investments, you don't want your P&L also to get impacted. You can classify those instruments as fair value through other comprehensive income. One-time choice, irrevocable choice, and when you subsequently sell off, the gain or loss will not again be reclassified into P&L. It has to be in equity only, right? Under equity, you will do some movements. We'll understand that subsequently. But from OCI, you cannot bring it to P&L. Now, so far whatever we have discussed, we have understood the meaning of financial instruments, and we have seen the classification as financial assets, financial liabilities, and equity. And for each of the classification, we have taken some examples and also the questions given in the study material. Then subsequently, we did the business model test and the contractual cash flows test and all of that. There also we did some kind of illustrations which helped us clear our concepts. Now, all of these are for your conceptual building. In the entire discussion we had so far, what you need to understand is what are financial instruments, right? Then what are financial assets, what are financial liabilities, and what is equity. Normally, financial assets are what? Like, your receivables, trade receivables, loan given, investments made, all of those are financial assets, and also derivative instruments which are favorable. Then there was something about settlement in own equity and fixed to fixed test and all of that. That also you can you need to remember, right? Then coming to financial liabilities, your trade payables, loan that you have taken, derivative instruments which are not favorable, right? And if there is an obligation to settle in own equity but it does not meet the fixed to fixed test, all those things are classified as liability. And then we had the residual category called equity, right? See, these are all conceptual things which you need to remember and understand, right? What you need to remember is what is a financial instrument and the definition of all of these three items, because in examination, if at all a theory question comes, you must be able to write down what is the definition of the particular item, or why is it a financial asset, why is it a financial liability, and why is it an equity. We have done the summaries multiple times, and please ensure that you remember those definitions, because it might be helpful when you address the theoretical questions. A lot of smaller conceptual based theoretical questions that we discussed, you can maybe go through them a couple of times, but don't break your head into memorizing all of that, because what you need to be clear of is what is the concept in that, rather than remembering the questions and answers, right? Then we understood the business model test, we understood the contractual cash flows characteristic test. Even there, don't try to boil the ocean, just understand what is the business model, what is the objective, and what is the contractual cash flow, solely the payment of principal and interest or not. Then we moved on to the classification of financial asset, where we understood financial assets can be classified as those measured at amortized cost, those measured as fair value through other comprehensive income, and those measured as fair value through P&L. Again, this classification is very, very important that you need to understand. Under amortized cost, two conditions have to be met. The business model objective should be hold to collect. That is basically you want to collect the contractual cash flows, and the contractual cash flows are SPPI, solely the payment of principal and interest, right? Coming to FV2OCI, the business model is hold to collect and sell. You are holding the financial asset to collect the contractual cash flows and to sell the financial asset. And the contractual cash flows are again SPPI, solely the payment of principal and interest. And the last category is the residual category, which is fair value through P&L. Then we also talked about exceptions. Something which can be measured at amortized cost or FVTOCI can be measured at fair value through P&L, irrevocable option. And for equity instruments which are not held for trading, those can be measured at fair value through other comprehensive income. That is irrevocable decision. It is a one-time decision and it can be taken on an instrument by instrument basis. Then once you exercise this option, whatever gain or loss are there, those will be accumulated under OCI, and on final disposal, you cannot reclassify the gains or losses from OCI to P&L. You can move from OCI to other components of equity. For example, from OCI you can move it to retained earnings, but it will never be impacting your P&L. This is the crux of the discussion we had so far, right? And now we'll move on to the next very important and interesting aspect, that is measurement of financial assets, right? Because this is a very long chapter, this because there are a lot of concepts to understand. Please ensure you are in track of whatever you are learning. Okay, I'll keep on revising and recollecting stuffs as and when I take the classes, but on your side also you must be clear. Okay, I have learned this item, and now we are moving on to the next item. Now that we have understood the various categories of financial assets, let's move on to the next aspect that deals with initial measurement and subsequent measurement of financial assets. Under initial measurement, we'll have some basic principles which is more or less very much familiar with you. But in case of subsequent measurement, it depends on whether we are measuring the financial asset at amortized cost or FVTOCI or fair value through P&L. Based on that, the accounting would change in case of subsequent measurement. When it comes to initial measurement, it is common for all the cases. There are some differences when it comes to FVT, PL and transaction cost. As we do it, we will be able to understand that. But before we jump into this, I'll give you a very simple broad example which will help you understand the flow of process while accounting for financial asset, right? Now, what are financial asset? Financial asset are cash, investments, contractual right to receive cash and all of that. We'll take the case of a contractual right to receive cash. Okay, say for example, we are talking about a company which provides loans to others, right? And the term of loan is such that it is a 3-year loan, an amount is given on loan, there is a fixed rate of interest which is charged. Interest is paid every year, and at the end of the tenure, the principal is paid back. Okay, we'll try to build these understanding so that later on when I tell you something called effective interest method, you should be able to understand that. Later on when I tell you principal payment, interest payment and all of that, you should be able to understand that. So the first case, let us take, it is a term of the loan is 3 years. Amount of loan is 1 lakh. We'll keep very simple. Okay, rate of interest 10%. And market rate of interest is also 10%. Meaning to say, when the company gives loan, let's say I am the company and I am giving you the loan, I give you the loan at 10%. What is the rate going on in the market? In the market also it is going at 10%. Sir, would it be possible to give loan? Would it be possible that a company gives a loan at a discounted rate? Maybe possible. Maybe I may think that you are my student, so I'll give you some benefit, I'll give you loan at 8%. Or maybe a company thinks to an employee, let me give it at a discount. Sometimes we'll have cases of interest-free security deposits where interest is not even being charged, right? So there may be cases where interest is not in line with the market, but here we are saying interest is in line with market and the rate of interest is 10% in both the cases. After 3 years, it will be repaid, right? So year 1, 2, 3, there are 3 years, okay. Now, what is the cash flow for the company? Cash flow is principal, cash flow is interest, and in the third year you will also get principal, right? And amount, if I put it 10%, 1 lakh multiplied by 10%, I get 10,000, then again 10,000, then again 10,000, and here it is 1 lakh. We have already discussed these kind of schedules in the previous sessions and also in other standards, but it is important that you understand the overall flow. Only then this standard would make sense to you. That is why, though it is simple, I am doing it again. Another 10-15 minutes of time if you spend, your concepts will be absolutely clear, and then further understanding will also be really good, right? This is the amount, 10,000 each. Now, if I am looking at from the point of view of the company, the company is getting what? Company is getting these cash flows. These cash flows the company is getting, and if the company has to determine what is the fair value of it today, what is the present value of these cash flows today, what the company would do? The company would discount it using the present value factor at 10%. So, 1 divided by 1.1, 0.9091, then this divided by 1.1 divided by 1.1, and the last one will be the same. So, what is the present value? Present value is 10,000 multiplied by this factor, 9,091, 8264, 7513, 75131. If you sum this up, you get present value as 1 lakh. So, what is happening here? The loan that I am giving to you, or the loan that the company is giving to an outsider of 1 lakh, getting an interest of 10%, but the market rate is also 10%, the fair value of that is 1 lakh. Normally, the transaction price will be the fair value. What is the transaction price here? Transaction price here is 1 lakh. I am giving you a loan of 1 lakh. And I'll collect interest of 10%, market rate is also 10%, so this will be the fair value. Think for a moment, if I take the same example, okay, no need to, write it down again in your books and all of that, this is more for an understanding. Market rate is 12% and I am giving you loan at 10%. Market rate is 12%, I am giving you loan at 10%, right? Now, I gave you 1 lakh worth of loan. Is that 1 lakh the fair value of the loan? If you ask me, if any person has a common business sense, why will he give it to somebody at a discount? Unless there is some kind of relation, unless there is some other kind of benefit that is coming to the entity, why will someone give a discounted rate interest loan? For example, if I am giving to an employee, I am giving it at a discount because employee is providing me services, or there is a related party, I may give it at a discount. But even in such cases, what the standard says is, boss, you may give at any transaction price you want, you may give at a discount, you may give at higher rate of interest, the initial recognition should be at fair value only. Sir, how do we determine fair value in this case? Simply think of it that if the company was to receive 10,000 of cash flows for each of the year and 1 lakh of principal repayment, how much of loan would have been given today at market rate of interest? That is the question you should ask. The thing again I am repeating is that if the company is getting 10,000, 10,000, 10,000 and 1 lakh over a period of 3 years, if these cash flows were to be received and 12% is the rate of interest, what would be the value of loan that the company would have given today? Basically I am asking, if the company has to make a loan today or give a loan today and get these cash flows, what will be that loan amount? Will it be 1 lakh? It will not be 1 lakh, because on 1 lakh the interest comes out to 12,000. So what we need to do is, we need to determine the present value of these cash flows at market rate of interest, which is 12%. So here you have 12%, this also you change to 12%, 1.12, this also you change to 1.12, 1.12, and this remains the same. Now it comes to 95,196. I gave 1 lakh of cash to my employee, and the value of the loan should have been only 95,196. What should we do with the difference? The difference will be employee benefit or employee compensation, and you will deal it in accordance with Ind AS 19. Normally, over the period of loan, you will expense that outright. So here what is happening is, see this, outflow on day 0 is 1 lakh. Outflow on day 0 is 1 lakh. Fair value of loan given is how much? 95,196. The company would have actually given 95,196 of loan only, but the company gave excess loan or excess over fair value 4,804. What is this? This you have to deal in accordance with Ind AS 19. Say for example, the company says, till the time you are with the company, you will get this concessional rate of interest. Then till that period, you will expense this item. Or if the company says, no, even if you leave tomorrow also, you can continue to pay us 10% rate of interest, then in that case, what we will do is, entire 4,804, we will treat it as employee benefit expense and charge off in the same period. Basically, you have to see what is the service condition and the vesting condition, and accordingly you will have to expense it. Sir, then what is this 95,196? This is your financial asset. Though the company has given 1 lakh, the financial asset is worth only 95,196, and at 95,196, if you apply 12% rate of interest and you prepare the schedule, you will reach to the final value of 1 lakh, correct? So this is cash outflow. You will credit cash or bank, you will debit financial asset, and this you will debit employee benefit expense. Now it may be employee benefit expense or deferred employee benefit expense, depending on what are the condition. If the company says, even if the employee resigns, he will continue to get 10% rate of interest, means it is the expense for the same, you will expense the entire amount in the same period. But if the company says the employee has to be in employment for 3-year period, only then this concessional rate of interest is applicable, then in that case you will defer it over the term of employment, right? So here this will be covered by Ind AS 109, this will be covered by Ind AS 19. Right. Now moving forward, we will come to how to account for interest and all of that separately, but if you prepare a schedule for this, 1, 2, 3, opening balance 95,196, interest at what? Interest at 12%. So the entity will recognize interest income at 12%, this multiplied by 12%, which is 11,424, received 10,000, and closing balance would be opening balance plus interest minus received, which is 96,620. Then opening balance 96,620, interest 11,594, received 10,000, closing balance 98,214, opening balance, interest, received, and closing balance 1 lakh. So basically it is 1,10,000 and closing balance is 0. So in year 1, entity would say financial asset, debit financial asset by 11,424, credit interest income 11,424, then debit cash, credit financial asset, debit cash by how much? 10,000, and credit financial asset by 10,000, right? So like this, year on year basis you will pass the entries. We will come to detailed problems and solutions on this, but then this is the crux that you need to understand, that the financial assets will initially be measured at fair value. Whether you are talking about amortized cost, whether you are talking about FVT OCI, or whether you are talking about FVTPL, we will measure at fair value only. There is an adjustment for transaction cost that we will come to it subsequently, where there is a different treatment if it is FVTPL and in other cases, right? But for now, you need to understand that the entity will account for this financial assets based on fair value only. Initial measurement will be done always at fair value. Sir, what if there are transaction costs? Now transaction cost something like, let us say the entity is giving loan, and the entity also charges processing fee. So for example, let me copy the same example again. There is a processing fee of how much? 2%. Means what? The borrower will have to pay processing fee of 2%. This processing fee of 2% means what? The borrower will have to pay a processing fee of 2%. Meaning to say, loan amount given is 1 lakh, right? So that is the amount that the company has given to the borrower. The borrower has to pay back 2% as processing fee. 2% of this will be 2000. So what does this mean? I gave you a loan of 1 lakh. On the same day, you have to give me 2000 of processing fee. What does that mean? In effect, I have given you a loan of 98,000 only. Correct? I have given you a loan of 1 lakh. You paid me 2000 on the same day. In effect, what does it mean? I gave you a loan of 98,000 only. Correct? So, here, net loan given. I am using this term net loan given, we will come to the exact technicalities later. Net loan given today is what? 1 lakh minus 2000. So from the company's point of view, there is an outflow. So if I have to, put it in a proper way, there is an outflow of 98,000 when on day 0. So today I gave you 98,000. End of year 1, interest received. It's an inflow. Inflow of how much? 10,000. Then year 2, interest received, inflow of 10,000. Then year 3, interest plus principal. This is also an inflow, 1 lakh 10,000, right? So what you need to understand is, there is a single outflow and there are these multiple inflows, 10,000, 10,000 and 1 lakh 10,000, which is the inflow, which is the inflow that the entity has received. Now, think of a case where we know the market rate. And if we discount this entire sum of 10,000, 10,000 and 1 lakh 10,000 at 12%, what happens? What do we get? We get 95,196 as the present value or the fair value, right? And what is the amount given? 98,000. So the difference of these two will be accounted as employee benefit expense. In the earlier case, what did we say? 1 lakh minus 95,196. In the earlier case, what did we say? 1 lakh minus 95,196 will be the employee benefit expense. Here it would be 98,000 compared with 95,196. So that is minus 95,196, 2803. This will be employee benefit expense. Okay. So this is how we will approach the questions. This is how you will measure the transactions. You must be very comfortable in working around with these kind of tables. Basically, the amortization table, what we call, this is the amortization table, opening balance, interest received and closing balance. This you must be able to prepare. You must also be able to calculate IRR. Okay, I will teach you IRR briefly in one of the questions. After that, you must be comfortable in calculating IRR. Most of the cases you will get in the question only, but you must practice and be perfect in calculating IRR. We have done it in other standards also, but for the sake of being able to recall all of those, I will do it once in a problem. After that, it is you who have to practice in calculating IRR. That is one thing. Then some of the questions or some of the concepts we will understand along with illustrations. See, there is no point in me explaining you very boring theory and at the end of it you don't get anything out of it, right? So in some questions we'll take an illustration directly and we'll solve and see, we'll solve and understand the illustration as well as the concepts involved in the illustrations, right? So with this understanding of these tables, and largely this is what is called the amortized cost method, whatever we are referring to, right? Amortized cost method, this is what is referred to it, and there is one pattern which will be frequently tested in the examination, so you have to be master of this. Let's take another example. Let's say there are two types of loans. One is a 5-year loan and one is a 3-year loan. Okay, and the amount borrowed is 10 lakhs. And here the amount borrowed is 5 lakhs and rate of interest is 10% here and it is 12% here, 10% and 12%, and processing fee of 1% is payable. Okay. So this is the thing. Now Market rate of interest is not known, and we assume that the rate of interest which is charged is the market rate of interest. Now, first thing, can there be two different rate of interest for two different period of loans? Yes, there can be. In fact, actually, the 5-year has to be costlier. I have taken it that 5-year is 10% and 3-year is 12%. Normally, the longer duration loans will be costlier. Okay, that is one. And always remember that if the market rate of interest is equal to the rate of interest charged in the loan, then the fair value or the present value of interest and principal will be equal to the amount of loan sanctioned. This you would have done multiple times, and we have done in the previous example also, that if the rate of interest 10% and here also it is 10%, if both of these are same, then the amount that is given will be equal to the present value of the cash flow that is received, right? But if the market rate of interest is lower, then the present value will be higher, and if the market interest rate is higher, the present value will be lower. These are some basic concepts that which you would have learned in time value of money and financial management, which you need to remember, right? So, coming over here, do I again need to calculate interest payable in each year and then take the present value factor and calculate the fair value? Not required. So, you can make a note of it. If rate of interest is equal to the market rate, then no requirement to calculate present value. Okay. Now, if this is the case, then what is the fair value of the transaction? Can I say fair value of the transaction? Now, if that is the case, what is the fair value of the loan? Present value is 10 lakhs and 5 lakhs, but what is the fair value of loan? In most of the cases, there is an assumption that the transaction price represents fair value. If it does not represent the fair value, then we will have to make certain adjustments. Now, coming to this 5-year loan, what is the processing fee? 10 lakhs multiplied by 1%, which is 10,000, and this should be 5,000. I don't need to calculate using this, right? 5,000, and for the second one it is 5,000. Now, coming to the fair value of the loan, what is the fair value of the loan? The loan, which the amount that has been given is 10 lakhs, which is the transaction price, and we assume that the transaction price represents fair value, but here there is a transaction cost also involved. What is the transaction cost? Transaction cost is 10,000 of processing fee and 5,000 of processing fee. So, the amount at which the loan will be recognized is, the recognition amount will be here 10 lakhs minus 10,000, 9 lakh 90,000. And here 5 lakhs minus 5,000, 4 lakh 95,000. So, the amount that will be recognized or the value that will be recognized is 9 lakh 90 and 4 lakh 95,000. Normally, the transaction price is representative of fair value. Now, what would happen is, because I am recording the financial asset at 9 lakh 90,000 and interest that I will earn, or if I assume that interest of 10% will be received, and if I prepare the schedule of loan, it will not match. Let us do for one case. Year, opening balance, interest, payment, closing balance. Okay, this is just for our understanding purpose. 1, 2, 3, 4, 5 years. Opening balance, because we have recorded at 990, 9 lakh 90,000. Interest rate at 10%, 9 lakh 90 multiplied by 10% is 99,000. Amount that the customer will pay will be 10% on 1 lakh. 10% of 10 lakhs, which is 1 lakh. And closing balance will be opening plus interest minus closing. And if you do it for 5 years, what you get is the closing balance of 983,895, or if you say the entire 11 lakhs is paid off, you get negative 16,105. Why is this amount coming as negative? Because the value of the loan that was given is 10 lakhs, but we have recorded only at 9 lakh 90,000, and we have adjusted the processing fee against the loan amount. Normally, what you would have done, if Ind AS was not applicable, if there is a processing fee, you would have credited to P&L. But here, processing fee under Ind AS, you are reducing from your financial asset. You have reduced the value of financial asset by by this processing fee, and you are recording the value at a net amount of 9 lakh 90,000. That 10,000 is a gain, right? That 10,000 is an income. That income has to be recognized over the period of loan. But sir, we have not recognized here. So, for this, we will need to calculate something called as effective interest rate. Sir, what is this effective interest rate? Effective interest rate is basically take the opening balance, take all the cash flows and calculate the IRR. Take the opening balance, that is initial outflow, take all the inflows and calculate the IRR, right. So now here in this case, I will calculate the IRR, which is the effective interest rate. So let us consider the 5 years, right, and what is the inflow? Inflow is 10,000 here. Inflow of 1 lakh first year, second year, third year, fourth year, and last is 1 lakh 10,000. Right. Present value factor at 10%. Why 10%? Because 10% is the closest one. I know we have to move back slightly, but we will start with 10%. 1 divided by 1.1, then this divided by 1.1, then this divided by 1.1, divided by 1.1. In the 5th year, the present value factor is this divided by 1.1, that comes to 0.6209. So you just multiply these two and you get the present value. I think you have done enough problems on capital budgeting and IRR. So the present value is 10 lakhs. Present value is 10 lakhs. But what is our present value here? 9.9 lakhs. If I have to reduce my present value, what should I do with the interest rate? I have to increase the interest rate. So I will increase the interest rate by 0.5%, present value factor at 10.5%. In examination, if they have given you the percentages, use the same, otherwise use the one which is pretty close. So here 1 divided by 1.105 first period, then this divided by 1.105, so on and so forth, you can calculate for the remaining portion. And what is the present value? 1 lakh multiplied by 0.9050, so you have 90497, like this you can calculate for each of the period, and you get the present value as 9,81,285. So at 10% it is 10 lakhs, at 10.5% it is 9,81,285. Now how do we calculate the IRR? This is a trial and error method. Difference in present value, what you have calculated is 10 lakhs minus 9,81,000, which is 18,714. Difference in rate of interest is 0.5%, right. So for a 0.5% difference in rate of interest, the difference in present value is 18,714. How much difference do we need to bring 10 lakhs to 9,90,000? We need, difference required is 10,000, right. So hence change in percentage should be how much? For 18,714, the percentage change is 0.5. How much is the change for 1 rupee? It is 0.5 divided by 18,714, and for 10,000 you multiply it by 10,000, you get 0.267%. So the IRR should be 10% plus 0.267%, that is 10.27% or 10.27%. That should be the IRR. Now that is the rate at which you will account for interest, right. So this is the effective interest. So in that case, what would happen is, here instead of doing interest at 10%, you will say interest at 10.27%. So why we have increased that interest rate? Because there is a processing fee income which we need to account for. That is what you need to understand. So this multiplied by 10.27%, do it for each of the period, and you see at the end you have a closing balance of 269. That is because of approximation. If I had taken 2.267%, the difference would be still lesser. It's come down to 86. If I take the exact IRR, then this difference will be 0, right. So this is the effective rate of interest. I gave 9,90,000 to somebody, I will get 1 lakh for 5 years, and at the end I will get 10 lakhs back as my principal. The effective interest, the interest which represents the series of cash flow, is 10.267% or 10.27%. Every period you will account for income of so much, and in that interest the processing fee also gets automatically accounted for. So this is what you need to understand as far as effective interest rate is considered, right. So now in the examination you may get two scenarios. One, effective interest rate or the interest rate applicable is given. then in that case you have to discount the cash flows and arrive at the present value. In another case where effective interest rate is not given, then you need to calculate the effective interest rate considering this scenario. Let us now understand in detail the measurement of financial assets. First we will talk about initial measurement, right. So we have financial assets. How do we measure them initially? We will do it at fair value plus or minus transaction cost. For this, we will divide the financial assets into three broad categories. The first category is your trade receivable, basically your debtors. Then you have financial assets which are measured at fair value through P&L, and then you have other financial assets, right. Now, what the standard says is, as far as trade receivables are concerned, if there is no significant financing component, or if the entity is choosing the practical expedient given by Ind AS 115, the standard says trade receivable shall be measured at transaction price. Trade receivable shall be measured at transaction price as per 115. When can you do this? You can do this if it does not have any significant financing component. If it has significant financing component, you have to remove the interest component and then measure it, right. So, for these cases where there are no significant financing component, you will measure it at transaction price under 115. So, for trade receivables, you will do it that way, right. Then, for those financial assets which you recognize at fair value through P&L, this will be at fair value. If you are measuring a financial asset and you are designating them as fair value through P&L, you will measure it at fair value. But sir, you told for other cases also we will do fair value. Yes, we will do fair value. Then coming to other financial assets which are not fair value through P&L and which are not this category of trade receivables, you will measure them at fair value plus or minus adjusting the transaction cost, okay. So, we will see on a case by case basis, we will take a lot of examples and understand how do we handle this transaction cost. If let us say the entity is incurring some transaction cost while giving loan, okay, let us say some kind of commission which is incurred or some kind of legal charges which is incurred while a loan is being given, then that transaction cost will be added to the fair value. So, for financial assets, you will have one fair value plus or minus transaction cost. If it is FVTPL, please remember transaction cost will not be included. Then what will we do with the transaction cost? This transaction cost here, transaction cost will be taken to P&L. If it is fair value through other comprehensive income, in that case you will do fair value plus or minus transaction cost, right. So, this is how you will measure financial assets at initial measurement. Now, we have understood that the financial assets, when you initially recognize, it has to be at fair value plus or minus transaction cost, right. Trade receivables you can ignore for now because that is again covered separately under Ind AS 115. Please remember, for FVTPL you will not consider the transaction cost will be directly taken to P&L. We will come to that when we understand financial assets measured at fair value through P&L, and when it comes to all other financial assets, it is fair value plus or minus transaction cost. Now, what is this fair value? Of course, the fair value is the fair value as per Ind AS 113, and there is a presumption that whatever is the transaction price TP, this will be your fair value. Whatever is the transaction price, that will be the fair value. There is a presumption, means generally let us say if you want to borrow from a bank or the bank is giving you loan, or if you are buying some courses at Indigolearn, or if you are making some investments in equity instruments, whatever you are doing, wherever you are creating a financial asset, the assumption is that the fair value is the transaction price, or the transaction price itself is the fair value, right. Now, why is this presumption? Say for example, there is a company, there is an entity A, okay, they have quoted debentures. They have quoted debentures in the market, and the market price, the current market price from an observable market is, let us say, 950. And now they want to raise money. What will they do? Most likely a common person with good business sense, they will issue the debentures at 950 because that is what is the market price. Considering the appropriate discount which would be applicable, let us say if you are making some kind of rights issue or something like that, that is still fine, but the transaction price generally reflects the fair value. Whatever is the transaction price being Whatever is the transaction price, that is the consideration involved, that represents the fair value. That is one thing, what is the presumption. But then there could be cases where fair value and transaction price are not same. For example, you give discounted loan to the employees, or you give interest free loan to your subsidiaries. In many cases, there could be a case where the fair value is not equal to the transaction price. Then what do we do? Even then, you will account it at fair value only. The recognition will happen at fair value. So then what about the difference? For example, fair value of loan is, let's say, 10 lakhs. Transaction price for the same loan is, say, 9 lakhs. What do we do with this 1 lakh of difference? For this 1 lakh of difference, it depends on whether this fair value is based on, the active quoted market price, or, using only observable market inputs. If that is the case, then there is one treatment. If it is otherwise, then there is a separate treatment. So what the standard says is, the difference between these two, the fair value and transaction price, if fair value versus the transaction price, if there is a difference and fair value is determined using level 1 input, or it is determined using level 1 input, or using only observable inputs, then in that case you take it to P&L. If it is in other cases, then you will have to defer and amortize it, right? Now, the standard clearly does not tell us how to defer and amortize. Now, the standard is not very clear as to how do we defer and amortize. It just says you have to defer it. How do we defer it? Now, it depends on the facts and circumstances of the case. You may do it in the proportion of maybe interest income, or you may do it on a straight line basis. Whatever gives a true and fair presentation, in that basis you can defer and amortize, right? So, if the fair value and the transaction price are not same, and this fair value is based on a level 1 input, or only, it has to be only, you cannot add unobservable input. If you are getting confused regarding this level 1, level 2 inputs, observable, unobservable, please go back to Ind AS 113, right? So, if these are based on these two inputs, then the difference will be taken to P&L, and in other cases you will defer and amortize, right? So, that is the core principle given by Ind AS 109. Now, there are some circumstances, if you apply this, that may not reflect the true picture. In that case, you have to apply the principle of substance over legal form. So, the difference I am talking to you is, let us say there is a parent entity and there is a subsidiary entity. There is a parent entity, there is a subsidiary entity. Parent gave interest free loan of 10 lakhs. Interest free loan of 10 lakhs to the subsidiary, repayable after 5 years. Now, using only observable market, data for the credit rating, the, borrowing cost and all of that, let us assume the fair value of the loan is 6 lakhs. The fair value of the loan is 6 lakhs. Now, the transaction price is 10 lakhs, the fair value is 6 lakhs. What is the difference? Transaction price minus fair value, there is a difference of 4 lakhs. Now, as per the guidance given under Ind AS 109, what it says is, boss, this 4 lakhs, you have to defer it and you have to amortize it to P&L over a period of time. But then, if you look at the substance of the transaction, what does it indicate? See, I should have actually given a loan of 6 lakhs based on the repayment principle. Basically, I should have given a loan of 6 lakhs only. I should have given a loan of 6 lakhs only, considering the, credit rating of the subsidiary, the interest rate applicable, the repayment schedule. The loan should have been only 6 lakhs. The parent company gave a 10 lakh of loan, and right now I am saying this difference of 4 lakh, because it is not based on only observable market data, you park it off to, or you defer and amortize it to P&L. Or assume for a moment this 6 lakhs is based on level 1 input. The instruments are quoted in the market, and in that case what we are saying, difference, you charge it off to P&L. But if you look at the intention, or if you look at the underlying substance of the transaction, this additional 4 lakhs is nothing but like an equity infusion, right? So, this is not directly given in the standard, but then considering the various guidance given by the IFRS groups and all of that, if you get a scenario like this where there is some form of relation, and because of that relation there can be underlying hidden transactions, then you have to segregate that and account it accordingly. So here, though it is an interest-free loan and say this 10 lakhs is the transaction price, 6 lakhs is the fair value considering level 1 inputs and observable inputs only. Even then, this difference of 4 lakh, if you charge it off to P&L, it is not appropriate. So, this 4 has to be considered as an asset. It has to be considered as an asset and you will record it as an equity infusion because there is some form of relationship here, parent and subsidiary. So, that is one small thing you need to keep in mind, that not always you will charge it off to P&L. Some cases you may recognize it as an asset as well, right? But very rarely you will see, a level 1 input here. So, this would generally fall into the other category. So, coming back, if there is a difference between the fair value and transaction price, if it is based on level 1 or observable inputs, you will charge it to the P&L. This is the principle, right? And in other cases, you will have to defer and amortize. But then there has been a lot of opinion by the, facilitation group and all of that, where in specific cases, you may have to look at substance over form and then accordingly account for it. Don't blindly take it to P&L. But the principle is this: if the fair value is measured using level 1 or only observable inputs, difference is to P&L. In other cases, you will defer and amortize. Now, what is this fair value? Fair value is fair value as per Ind AS 113, and normally the transaction price reflects the fair value or represents the fair value. Now, in cases where transaction price is not equal to the fair value, what do we do with the difference? Here the standard says, check how the fair value was determined. If the fair value was determined using quoted prices in active market or using techniques which use only observable market data, basically the level 1 inputs, then in that case the difference will be taken to P&L. In other cases, the difference will be deferred and amortized, right? That is the principle. Now, while doing this, you have to look at the substance over form as well. What do I mean by that? If there is a transaction between related parties, let us say a parent company and a subsidiary company, the parent company has given an interest-free loan. The fair value of that loan, as we discussed in the example earlier, is lesser than the transaction price. Now, in such cases, will you take the difference to P&L? It may not be appropriate to take differences in the P&L. So, whenever there is a relationship, you look at the substance over legal form and accordingly decide whether the difference has to be taken to P&L or the difference may be actually an asset, right? The difference here, when the parent company gives a concessional loan to the subsidiary or interest-free loan to the subsidiary, the difference is a form of asset to the parent company in terms of investment in equity of the subsidiary, right? We have seen that in the example as well. So, if they are unrelated parties, then the difference will be taken to P&L. But if they are related parties, the difference may not be taken to P&L, right? And also, if the fair value is not determined using, observable market inputs or level 1 inputs, then the difference will have to be deferred and amortized, right? It has to be considered on a case-to-case basis and accordingly you have to write the answers. Now, I told you that in some cases you have to take the difference to P&L, in some cases you have to defer it. So, it can create some confusion, right? And also you have to check if what the substance over form. So, let me summarize all of these for you so that you are not confused in your examination. Please remember, for initial recognition, financial assets are always measured at fair value plus or minus transaction cost. Then, if it is a financial asset which is designated as measured at fair value through P&L, you will only measure it at fair value. Transaction cost will be directly taken to P&L. So, normally fair value plus or minus transaction cost. In case of fair value through P&L, in that case, you will measure it at fair value and the transaction cost will be taken to P&L, right? That is the first aspect. Now, what is this fair value? Transaction price will be considered as fair value in most of the cases. But in some cases, the transaction price may not reflect the fair value. There may be a difference. Now, how do we handle the difference between the fair value and the transaction price? For that, you have to check whether the fair value is determined with reference to quotes from an active market or by using techniques which use only observable market inputs. In these cases, the difference will be taken to P&L. In other cases, the difference will be deferred and amortized, right? Now, when you have to defer and amortize, you can use it in the proportion of the interest or you can do it on an SLM basis based on the case-to-case situation. Now, in some cases, this difference may be recognized as an asset. For example, if there is a relationship between the two entities and the transaction price and the fair value are not same, then the difference may result in an investment in a subsidiary. If the parent company is giving, let us say, interest-free loan or a loan at a concessional rate, right? Now, a very key component of the initial measurement is the transaction cost. What are transaction costs? Transaction costs are the incremental cost incurred for acquiring or disposing of financial asset. Similar definition is there for even financial liability. Actually, there is a single definition. It basically means the cost which is incurred when you acquire a financial asset, and if you had not acquired the financial asset, you would not have incurred that cost. For example, if you are investing in an equity instrument of another entity, then in that case, you will incur some costs like brokerage charges, stamp duty and all of that. Those are transaction costs. Or say for example, you have to incur some legal cost for a loan sanction. That is also a transaction cost, right? So those costs which would not have been incurred if the financial asset was not acquired is called the transaction cost. Now let's take another example where the entity is not incurring a cost, but it is getting something in return from the other party. Say there is entity A, there is entity B. Entity A sanctions a loan to entity B and the loan is given at below market rate. Now why would someone give a loan below market rate? Either there is some kind of relation or there is some other benefit which is flowing from the other entity, right? So assume they are not related parties and entity A has given loan to entity B at below market rate, and in return entity B provides some kind of services or entity B gives an upfront fee to entity A. Now in such situations, how will you measure the financial asset? So say the financial asset, the transaction price is 5 lakhs and 1 lakh is the upfront fee paid by the borrower, that is entity B, to entity A. Now in this case, the financial asset will be measured at the net transaction price, which is 5 lakhs minus 1 lakh, that is 4 lakhs. Let's have a look at a question. Don't expect such kind of easier questions in the exam. This is more for a conceptual clarity. Containers Limited provides containers for use by customers for multiple purposes. The containers are returnable at the end of the service contract period 3 years between Container Limited and its customer. In addition to the monthly charge, there is a security deposit that each customer makes with Containers Limited for rupees 10,000 per container, and such deposit is refundable when the service contract terminates. Deposits do not carry any interest. Analyze the fair value upon initial recognition in the books of customers leasing containers, where the market rate of interest is for a 3-year loan is 7% per annum. Now what does this mean? This basically means that Container Limited is providing containers, which is an asset, to customers for a period of 3 years. You pay monthly, charges, whatever is there, and apart from that, the customers are required to make an interest-free refundable deposit of 10,000 per container. And normally, if you look at the market rate of interest for a 3-year loan for a similar credit profile, you will get 7% per annum. Now what does this mean? This basically means that if the company, instead of making deposit of 10,000 with this particular entity, if they give it out on loan, they will get 7%. Now does it mean that today I will recognize a deposit of 10,000 and I will keep on adding interest at 7% for 3 years, and at the end of the 3rd year I will get back 10,000 plus interest? The entity will not get back 10,000 plus interest. What will the entity get back? The entity will get back only 10,000. Meaning to say, the customer or the one who is leasing the container will get 10,000 after 3 years. Today I pay 10,000. After 3 years I will get back 10,000. Now how do we account for such transaction? That is what we need to understand. Now if you look at this scenario, today you give 10,000. There is an outflow. Now you get after 3 years, how much? 10,000 as an inflow. Now how will you evaluate this thing? Now will you say that today we have given 10,000, and after 3 years we should get 10,000 plus interest thereon, that is receivable is 10,000 multiplied by 1.07 to the power of 3, that is compounded for 3 years, that will get 12,250, and hence 2,250 is the additional amount payable. Or will you say 10,000 is the amount receivable after 3 years, so today's worth is 10,000 divided by 1.07 to the power of 3. Basically, will you do a compounding on 10,000 or will you do a discounting on 10,000? That is what you need to remember and make it right in your heads, right? So the way you need to evaluate is, I will get 10,000 after 3 years. What is the value of that 10,000 today? Considering 7%, today's worth is 8,162.98 or 8,163, right? So that is 10,000 divided by 1.07 to the power of 3. This is what is the present worth, right? But today how much did I pay? Amount paid today is 10,000. So what is the excess paid? 10,000 minus 8,162, that is 1837. So this is the fair value of deposit as of today. This is the transaction price and this is the difference. Now what do we do? What do we do with this difference? See, we cannot take it to the P&L because it is not based on level 1 or observable inputs. Then what do we do with such differences? In case of such differences, it has to be deferred and amortized. Now how do we defer and amortize? Here this is a case which is linked to leases. You have taken some container on lease, right? So there is a right of use asset which is being taken, and this extra amount that you have paid, is like your prepaid rent or lease payments in advance. Sir, why lease payments in advance? Simply put, boss, today if I had given 8,163 to a third party, I would have got 10,000. But to this person I paid 10,000. Now in that 10,000, 8,162 represents present value of deposit. The extra amount over that represents a component of rent that I am paying. Or you can say that represents the leasing services that I will receive, a payment towards leasing services that I will receive in the future. Because to a third party, if I had given this 8,162, he would have given me 10,000 after 3 years. But to this person, I have given 10,000 today. So whatever extra amount I have paid, is that not something like, payment towards using of that assets? So that takes the nature of prepaid rent and it will be dealt in accordance with Ind AS 116. Let me tell you one thing, friends. In most of the cases where there are no relationship between two parties, this is how the treatment would happen. Okay, if there is a relationship, then you have to look into the relationship and then decide what should be the accounting treatment. Let's now have a look at one more example, and with this example we will also understand how would the journal entries be passed. Normally not tested in the examination, but again if it is tested, it will be a very easy scoring point, right? So let's say there is an entity which makes a loan of rupees 10 lakhs, tenure of the loan is 5 years, rate is 5%. So the rate which is charged on the loan is 5%, market rate of interest is 8%. Now tell me one thing, will somebody give a loan at below market interest rate? No, right? And even if it is made, there will be some other form of benefit. Now if you see here, there is an upfront fee paid by the borrower 1,20,000. So entity gave a loan of 10 lakhs, from that 1,20,000 is given back to the entity itself. So these are the ways in which transactions can be structured. If you don't apply Ind AS, you would say this entire 1,20,000 is the gain for the year in which the loan has been sanctioned, and on the remaining thing you keep on charging 5% rate of interest. But now because Ind AS is in place, you ensure that this 1,20,000 is not a gain for the first year. This is actually, I give 100 to you and you are giving me back 12 immediately. So here it is a case like I give 1000 to you and you immediately give me back 120. So on a net basis, how much has been given? How much of loan is sanctioned? It is only 8,80,000, right? So in such cases, what you need to do is you need to discount the cash flows by using the market rate, arrive at the present value, right? That is a fair value. Compare that with the net transaction price, and then if there is a difference, you apply the principle of whether it is based on level 1 input or other than level 1 input, right? So here let us see what happens. Here, if you see 1, 2, 3, there are 5 years, right? 5 years. I will directly say the cash flows now. Cash flow is 10 lakhs multiplied by 5%, 50,000 in the first year, 50,000 in the second year, third year, fourth year, and in the fifth year it is 10 lakh 50,000. Discounting factor at 8%. Always calculate the present value using the market rate of interest. So this will be 1 divided by 1.08 first period, 0.9259, then this divided by 1.08, this divided by 1.08, that is 0.8573, 0.7938, 0.7350, 0.6806, right? Now here, because I am doing on an Excel, the amounts will be exact, but because you will be using calculator and rounding off, the amount will be different. So what I will do is, especially in this chapter, instead of using actual numbers given by Excel, I will also punch it hard using hard code 0.9259, 0.8573, 0.7938, 0.7350, and 0.6806. Okay. So, present value will be 50,000 multiplied by 0.9259, 46295, 42865, 36690, 36750, 714630. Right. What is the present value of this? Present value of loan payments is 8,80,230. Now, what is this? 8,80,230, if you see, is nothing but the net transaction price. Net transaction price is 10 lakhs minus 1,20,000. I gave 10 lakh, the entity gave 10 lakh, collected 1,20,000. So, the net transaction price is 8,80,000, and here we have got 8,82,30. That is because of rounding off. Had I used exact numbers of Excel, I would have got 8,80,000 only. That's how the question has been structured. Okay, some difference here and there. So, what we can consider is this 8,80,000, which is the net transaction price. This is the fair value. This is the fair value, and accordingly you can do the accounting for it. Now, this is the first check you have done. Now, the second thing you have to do is you have to prepare the amortization schedule. So, amortization schedule is basically your interest and principal repayment schedule. So, here opening balance, interest at always market rate, payments, closing balance, right. So, year 1, 2, 3, 4, 5, opening balance 8,80,000, interest at 8%, this multiplied by 8%, payments 50,000, closing balance is opening balance plus interest minus payment, which is the closing balance, right. So, similarly, opening balance, interest, payment, closing balance, they keep on doing this for each of the period. You reach 9,99,679, and that is because of rounding of difference. So, what you can do is you can just delete this. So, what you can do is you can add the differential part. So, that works out to 321, right. So, I will just add 321 to this, which makes it 10 lakhs, right. So, the closing balance, if you see, when you get 10,50,000, that will become 0. Now, how do we account for now the next question is, how will the entity account for it? The entity will account for a financial asset at fair value. So, initial recognition. What will you do? You will say financial asset debit by what amount? 8,80,000 to bank 8,80,000. That is the first entry. Then end of years 1, 2, 3, 4, 5. End of each year, you will recognize interest. So, you would say financial asset debit to interest income, because you will get interest income. First year interest income will be how much? 70,400 debit, 70,400 credit. Okay. So, I am writing in the single column. In exam, please write in 2 columns, and don't try to make a summarize thing, kind of summarize entry like this. You have to write entry by entry. Okay. Second year 72,032 and 72,032. Third year 73,795, 73,795. Fourth year 75,698, 75,698, and fifth year you will have 78,075 and 78,075. This is the interest entry. Okay, each year. Then this is the interest income. Then amount received. Amount received will be what? Bank account debit to financial asset, right. So, first year 50,000, 50,000, 50,000, 50,000, 50,000, 50,000, 50,000, 50,000, and in the fifth year 10,50,000 and 10,50,000. Okay, I really doubt if you get such kind of easier questions in the examination, but here please remember what we have done. We have recognized the financial asset at the fair value, which is the net transaction price at the beginning. Then we have recognized income each year, and also we have passed the amount received entry. If you prepare a ledger account for this financial asset, ultimately it will be 0, because it will follow this particular pattern: opening balance, interest, payment, closing balance, so on and so forth. Now friends, we have understood that whenever we talk about financial assets, at the time of initial measurement, we do the measurement at fair value. Of course, the transaction costs are adjusted to it, and normally the transaction price itself is the reflection of the fair value. In case of financial assets which are designated as fair value through P&L, we will not adjust the transaction cost, right? That part of initial measurement we have understood. Now, we will understand the subsequent measurement of financial assets. Now, the subsequent measurement depends on the classification of the financial asset, whether it is classified as financial asset measured at amortized cost or FVTPL or FVTOCI, right? Depending on the classification, the subsequent measurement would change, right? So, when we talk about financial assets measured at amortized cost, initially you will recognize it at fair value adjusted for the transaction cost, and subsequently you will add interest and reduce the repayments that are done. We have already prepared a couple of tables on this. We have also understood the meaning of amortized cost. Now we will take one more example to understand how do we account for financial assets which are measured at amortized cost. Now in this example we will see the difference between the fair value of the security deposit and the transaction consideration, and how do we treat the difference in such cases. So pretty simple question actually. A Limited has made a security deposit for lease whose details are described below. So, security deposit is made. Make necessary journal entries for accounting of the deposit in the first year and last year. Assume market interest rate for a deposit for similar period to be 12% per annum. Now, what does this statement mean? This statement means that if this entity had to deposit the same amount somewhere else, they would have earned 12% rate of interest. Date of security deposit, start date 1st of April of year 1. End date 31st March of year 6. Now, don't count it as 6 years, it is only 5 years, because from April 1 to March 2, that will be the first year. So, you will have total of 5 years. Discount rate they have given it as 12%, already mentioned here, you will use the same discount rate, and security deposit amount is 10 lakhs, and the present value factor at the 5th year is 0.567427. Whenever you have been given specific present value factor, please use that specific present value factor in the solutions, okay. You can do it based on your calculator also, but if a specific factor is given in the question, 3 digit, 2 digit, rounded off, 5 digit, 6 digit, whatever it is, use that to solve the problem, right. Now, this kind of question we have already done earlier for calculation of the present value or the fair value. So, before you move ahead in the video, please pause the video, calculate two things. One, the fair value of the deposit or the present value of the deposit, and the balance amount which should be considered as prepayment of lease, right. So, these two things you calculate, only then continue watching the video, because you also need to practice. I will keep on solving. If I solve 1000 questions, you will understand all those 1000 questions, but till the time you practice on your own, it may be slightly difficult. So, what you do is, you take this information, calculate that, and then you can continue watching the video. Now, let's solve this question. Always remember, whenever there is a question on financial instruments, we are talking right now about financial assets, you need to determine the fair value that will be used for initial measurement, and then for subsequent measurement, whenever a financial asset is measured at amortized cost, you will have to add the interest and reduce the payments that have been made, right. Now, in this case, what is the amount of deposit made? Amount of deposit is 10 lakhs. Right, this is the amount of deposit. Now, that is the payment made today. Now, after 5 years, once the lease period is over, what is the amount the entity will get back? The entity will get back 10 lakhs. What we need to determine is the present value of deposit which will be repaid after 5 years, because under the contract, the entity will receive 10 lakhs after 5 years. What is the present value of that? So, basically what we do is, if today we gave some amount to an outsider such that the outsider gave us 10 lakhs after 5 years, what would that amount be? What would be the present value be? That is what will be the fair value of the deposit that is made, right. So, what happens? So, here present value of deposit which will be repaid after 5 years, we have the present value factor 0.567427. So, that is 10 lakhs multiplied by 0.56 7427, you get 5,67,427. So, what this means is, I am repeating once again, one last time, after this I will not repeat this. If we give 5,67,427 to a third party, which will fetch the rate of interest at 12% per annum, this amount will become 10 lakhs after 5 years. So, today I would have given only 567,427 as a deposit amount, but how much have I given? I have given 10 lakhs. So, excess amount over the fair value is 10 lakhs. 10 lakhs minus 567,427, you get 432,573. This is the excess amount given. What do we do with this excess amount? Please remember the concept that we have understood. If there is a difference between the transaction price and the fair value, then the difference, if it is determined based on the level 1 inputs, we will take it to P&L. Is it based on level 1 input? No, it is not based on level 1 input. Then in other cases, we will defer it and amortize it, and if it qualifies to be an asset, or if we can consider it as an asset under any other standard, we need to consider it as an asset in that particular standard. So, when we consider this as an asset under another standard, even there we are deferring and amortizing it. So, ultimately what Ind AS 109 says, this difference of 432,573, if the fair value is based on level 1 input, write it off to P&L. If it is not based on level 1 input, then you will have to defer and amortize it. Now, here in this case, this extra amount that we are paying today, that will be deferred and amortized as per Ind AS 116, we will consider it to be a prepayment of lease rent or lease payments made in advance, right? Now, how will we amortize this? If you go back and if you recollect the right of use asset accounting, we know that any lease prepayments that are made, that will be added to the right of use asset. So, basically this amount will be debited to ROU asset and it will be amortized along with the right of use asset. Now, here we do not know what is the ROU asset value in. Now, here we do not know other information about lease payments. So, what we will consider is this 432,573, that itself is the right of use asset and we will amortize it over a 5-year period. Now, here the question says entry for the first year and entry for the 5th year. Now, when you need to pass the entry for the 5th year, you need to know what will be the interest component. So, for that you will have to prepare the entire schedule. So, basically you will have year, opening balance, interest. Is there any payment in between? There are no payments in between, so you can directly take the closing balance, right? 1, 2, 3, 4, 5 years. Opening balance for deposit is 567,427. So, this is basically the deposit amortization schedule. Interest will be at 12%. So, this multiplied by 12%, 68,091.24. The closing balance will be 635,518. So, basically what are we saying? The fair value of the deposit today is 567,427. On this, the entity will earn a 12% interest. The entity will earn a 12% interest, and this interest is arrived at using the effective interest rate method. Most of the times it will be given to you in the question. If it is not given to you in the question, you will use the IRR method and then you will calculate it. Okay. So, you will take the opening balance, interest of 68,091.24, and you get the closing balance. Then opening balance for the next period, interest at 12%, closing balance. So, I will just add 2 digits. Yeah, opening balance, interest, closing balance. Opening balance, interest, closing balance, opening balance, interest, closing balance. It is exactly 10 lakhs, 0.25. So, that 0.25 you can ignore. So, every year the entity will account for this interest, and this interest is using what? Effective interest rate method, right? So, when we pass the journal entry for the first year, what all we are supposed to do? In the first year means the transaction is entered into, we have paid 10 lakhs. Now, the 10 lakhs constitutes of 2 parts. One, the present value of the deposit, which is a financial asset, and the second component will be the right of use asset, which will be accounted as per Ind AS 116, and there is a 10 lakhs of cash outflow. At the end of first year, the entity has to account for interest income. At the end of second year, third year, fourth year, fifth year, you will account for interest income, and at the end of the 5th year, you will get back 10 lakh rupees from the other party, or that is the lessor. What do we do with right of use asset? That right of use asset, whatever amount you are capitalizing, that will be amortized, right? That will be amortized. So, year 1, journal entries, initial recognition. See, the fundamental rules of journal entries will not leave you till the final exams and also after you qualify. You will have to pass journal entries. Whether you have SAP, whether you have any other ERP, journal entries are a must, right? Especially the closing entries and entries like this. So, initial recognition, you will debit a financial asset, that is security deposit, which is a financial asset. Debit by what amount? This will be debited by the opening balance or the fair value or the present value, 567,427. Then you have right of use asset. This is the prepayment of lease part to bank, because 10 lakhs is paid. So, this plus this 10 lakhs is paid, right? Initial recognition. Then end of year 1. End of year 1, what all will happen? You have to amortize the right of use asset and you will have the interest income. So, interest income, when you recognize, you add it to security deposit financial asset debit by the interest amount, which is 68,091.24 to interest income. 68 interest income 68,091.24. Now, what happens is, please see the flow of transaction. When I am debiting 68,091 to the security deposit, my security deposit value increases. So, like this, every year when you add interest, ultimately the value will become 10 lakhs and the interest income will be credited to P&L. So, whenever you are following the amortized cost method, interest will have to be accounted for using the effective interest method and the interest income will be credited to P&L. Sir, will we have dividend income? Think of it and get an answer on your own. Okay. So, this interest income will be debited or will be transferred to P&L. $68091.4, $68091.24. Then you will also have amortization, right? So, amortization, right of use asset, how much? Whatever is the right of use asset, 432,573 divided by 5 years, assuming straight line method, 86,514.60. If you have not completed Ind AS 116, please ensure you complete that. See, financial instrument is one topic or one standard which you need to come to after understanding other standards, because time and again I will keep on telling, Ind AS on government grants, Ind AS on revenue, you have to go and refer to that standard, this standard. Unless you understand those standards, it becomes difficult here. So, right of use asset amortized to right of use asset 86,514.60. This will also be transferred to P&L. Profit and loss debit 86,514.60 to amortization ROU asset 8651.60. So, these are the entries to be passed in the first year. Then you are also required to pass the entry for the last year. Last year also you will recognize security deposit to interest income, right? And how much is that amount? That will be based on this table, 107,142.88, right? Now, if you do not want to prepare this particular table, so why do we prepare 5 years table? Then what you can do is, you will get 10 lakhs at the end of the 5th year. So, 10 lakhs divided by 1.12, if you do, you get opening balance as 892857.14. The difference between this and 10 lakhs will be 107,142, the same amount that we have got here, right? So, in case you want to save time, what you can do is, you can discount this by one period. So, 10 lakhs divided by 1.12, you get this and you multiply that with 0.12 and you will get this particular interest amount, right? So, this is the interest income recognized. This again you will transfer it to P&L, you can pass the entry, and the next entry will be amortization. Now, for amortization the values will not change, because every year the amortization is same, so 86,514.60. And the third thing that will happen is, you will realize the deposit back. The lessor will give the deposit back. So, you will debit bank 10 lakhs and you will credit security deposit, which is the financial asset, by 10 lakhs. Now, How has this changed the accounting if you compare it without Ind AS? Let's say for example there was no Ind AS, then what you would have done? You would have said security deposit 10 lakhs to bank in the first year, and when you would have received back the amount, you would have said bank account debit to security deposit. You would not have recognized this income, interest income and amortization. You would not have recognized these two, because you would have said, okay, I have given deposit of 10 lakhs, it is interest free and I will get back 10 lakhs after 5 years. Now what Ind AS emphasizes is, you have made a deposit of 10 lakhs, okay, you will get back 10 lakhs after 5 years, but 10 lakhs after 5 years is not 10 lakhs today. 10 lakhs after 5 years is 567,427 today. So that should be the value that you should give as deposit, but then the lessor will not agree. Lessor says give me 10 lakhs. Then Ind AS says, okay, you give 10 lakhs, 567,427, treat it as deposit amount. On this you recognize interest income, because when you make a deposit, for example with a bank, you will get interest, right? Similarly here also, think you are making a deposit of 567,427 and recognize interest income over a period of 5 years, and this balance of 432,573, that is over and above the fair value, that you consider as if you have made a prepayment of these rentals. And if you see another interesting thing, the total interest that is recognized over a period of time is 432,573, which is nothing but the ROU asset. And if I add amortization here, 432,573 divided by 5, so basically what happens is, the interest income and amortization, the net of each other. So in the initial period you have an expense 18,423, an expense reduced, then income, then income. So it actually ensures that you consider the time value of money and account for interest and expense. See, over a 5-year period the net impact is 0. The net impact is ultimately 0, but this gives a true reflection of time value of money. Now you might be wondering that if we split the deposit between fair value of the deposit and prepaid rent, how does it impact the accounting? Let me give you some scenarios and you'll understand why we should split the deposit between the fair value and the prepaid rental part. Okay, say for example you want a place on rent. You went out and you started searching for a place, you found a particular flat. The landowner or the lessor, he quoted 25,000 per month as lease rental, and he said you have to give me 3 months deposit, right? Now 25,000 and 3 months deposit is the deal that he has given. Now you are thinking to try to manage your cash flow, and you tell the landlord that, do one thing, I will give you more deposit on which you can earn interest. Okay, I will give you more deposit, maybe I will give you 1 year's deposit. Please reduce the rental amount. Please reduce the rental amount. So the landlord would reduce the rental amount because he is getting a higher deposit, and on higher deposit he can earn interest, right? So he will reduce the rental. So what has happened here? You gave a deposit upfront on which you would have earned interest, you did not earn interest. You gave the deposit to the landlord, which is a higher amount, and you reduce the rental expenses. Now these kind of tricks can be used to manage the books of accounts, to window dress the accounts. I will not call it exactly window dressing, but to manage the books of account. Say you want to reduce the expenses side of your P&L, or you want to reduce the rental expenses in the P&L. You may say, okay, I will give you extra deposit. You reduce the rent, right? You reduce the rent. Whereas actual impact is what? You are giving a deposit, a higher deposit, you are reducing the rent, you are also losing out on your interest income, correct? So to show the true nature of the transaction, we split here between the fair value of the deposit and the prepaid rental part, right? I hope the logic is clear as to why we should split. And see, when you run into transactions which are into crores, right, it makes a lot of difference on the P&L. Now we have understood subsequent measurement for those financial assets which are measured at amortized cost. Let us move on to the next category where we have financial assets which are measured at fair value through other comprehensive income, FVT-OCI or FVOCI, right? Now in case of FVT-OCI or FVOCI, how do we subsequently measure? Now here please remember friends, there are two aspects. One is you will have either interest or dividend. Now think of it, can we have dividend in case of fair value through other comprehensive income? Because under FVOCI also, we have understood that the business model is to collect contractual cash flows and to sell the financial asset. Now, dividend is not a contractual cash flow. Then why am I writing dividend under FVT-OCI? Because there is an option given to the entity where they have, let us say, investments in equity or equity instruments of another entity which are held as financial asset. Those can be irrevocably designated as FVT-OCI, and in that case you may have dividend. Okay, so interest and dividend is one aspect. Second is of course the fair value changes, right. Now, interest and dividend will be recognized in the P&L. When it comes to interest, you will use the effective interest method. So, here also in case of fair value through other comprehensive income, you will use the effective interest method which you had used under amortized cost method. So, same way, the way you calculated interest income, the same way you will calculate the interest income and you will record in this case. Then what about dividend? Dividend will be taken to P&L as and when the income arises. Okay. So, this is the interest and dividend part, and fair value changes will be accumulated in other comprehensive income. Fair value changes will be accumulated in other comprehensive income. If there is a gain, you will credit. If there is a loss, you will debit other comprehensive income. Now, the balance in OCI, what do we do with that? Now, we would have accumulated the fair value changes in OCI and it is an accumulated balance. Now, what do we do with this accumulated balance when we dispose of the financial asset? Now, it depends on what is that you are holding. If it is equity, equity of not own entity, equity of another entity, then this will not be reclassified. This will not be reclassified to P&L. Why? Because we have understood that if an entity designates an investment in equity as a fair value through other comprehensive income, then the accumulated balance in other comprehensive income will never be taken to P&L. Even if you de-recognize, it will have to remain in equity only. It may be transferred to retained earnings, but it will never be transferred to the P&L. That is one thing you need to remember. In case of other financial assets, here please remember this equity, this is not equity of the entity. This is a financial asset which is equity instrument of another entity, right? And in case of other financial assets, when it is de-recognized, it will be reclassified to P&L. Whatever is the balance in the other comprehensive income, it will be transferred to the P&L. So, when it comes to fair value through other comprehensive income, interest and dividend will be recognized in P&L using the effective interest method in case of interest, and fair value changes will be accumulated in OCI, and ultimately when it is de-recognized, it will be reclassified to P&L. Very important to understand that in case of equity, you will not reclassify it to P&L. Now, what we will do is we will take one example and understand this interest accounting under amortized cost method, parallelly under the FVT OCI method, and then see how will we calculate the interest and how do we accumulate the OCI and what is the overall impact in the P&L, right. But please remember, if it is an equity, you will not reclassify the other comprehensive income to the P&L. Now, we will take a single example, and in the same example, we will apply the fair value through other comprehensive income method and also the amortized cost method and see how is the change in accounting, right. So, say for a moment there is a financial asset, we have made investments in debentures at 1 lakh. Okay, this is the investment in debentures. While making the investment in debentures, we incurred a transaction cost of, let us say, 2000. 2000 is the transaction cost. Okay, rate of interest on debentures is, let us say, 10%. Rate of interest on debenture is 10%, meaning to say every year you will get 10% interest, and say tenure is 3 years. Okay. Now, if the tenure is 3 years, you will get 10% on 1 lakh for 3 years, and at the end of it you will get the principal amount as well, right. Now, here what is my effective rate of interest, or what will be my effective interest rate, assuming 10% is the market interest, assuming 10% is also the market interest rate. What is my effective interest rate? Now, here because there is a transaction cost involved, my effective interest will be lower than this rate of interest that I am getting on the debentures, right, because I have made an investment of 1 lakh plus I have incurred 2000, but I am getting interest only of 10,000 every year. So, my interest rate will be lower, right. Now, how much is the interest rate? You can calculate using the IRR method. In most of the cases, it will be given to you in the examination. Here what I will do is, I will use the help of Excel and quickly compute the IRR. Okay. So, on year 0, you paid 1 lakh 2000. Year 1, you would get 10,000. Year 2, you would get 10,000. End of year 3, you will get 1 lakh 10,000, right. So, for this, how much is the IRR? If I calculate, the effective interest rate works out to 9 point some percentage, let us see. 9.207%. So, this transaction, the effective interest rate is 9.207 percentage. 9.207 percentage. Okay. And if you prepare an amortization schedule, you have years, opening balance, interest at 9.207%, then payment and closing balance, right. Now, year 1, 2, 3, opening balance is 1 lakh plus 2000, effective interest is this multiplied by 9.207%, payment is 10,000 because every period you will receive 10,000, closing balance will be opening balance plus interest minus payment, which is 1,01,391, right. So, this we calculate for 3 years, interest, payment, closing balance, interest, payment, closing balance is 1 lakh. So, assume for a moment you get 1 lakh 10. So, here you will get 1,10,000 in the third period. So, the closing balance will be 0, right. Now, when we look at the journal entries in the first year, year 1, what is the journal entry? Financial asset, debit 1,02,000 to bank 1,02,000, right. 1,02,000, 1,02,000. Now, whether you follow amortized cost method or whether you designate the financial asset as fair value through other comprehensive income, initial recognition will be the same. Now, think of it and tell me what will be the initial recognition value if this is fair value through P&L. In that case, you will only measure it at 1 lakh. The 2,000 of transaction cost will be ignored, right. So, here the initial recognition entry is financial asset debit to bank 1,02,000, 1,02,000, and it will be same in both the cases whether you are following amortized cost method or whether you are following FVOCI method. So, on this part you will see FVOCI, here you would see amortized cost method. So, under FVOCI also you will have 1,02,000 of debit and 1,02,000 of credit, financial asset and bank, right, there is no change. Now, at the end of year 1, what all will happen? You will have to recognize interest, So, say for a moment you have recognized interest, in this case, which is financial asset debit to interest. How much is the amount? Financial asset debit 9391.14 and 9391.14 interest. Now, under FVOCI, fair value through other comprehensive income, even here you will need to recognize the interest income. Sir, how will we recognize the interest income? You will apply the same method, which is the effective interest method or effective interest rate method, which you have used in this amortized cost method. So, here also you will recognize interest income in the same way you account for interest under ACM. So, here the interest income will be 9391 and here also the interest income, the amount you will credit will be 9391, right. So, the interest accounting will be same under amortized cost method as well as FVOCI method. You will need to prepare the same table. Now, what is the difference then? The difference between these two is the fair value computation, but before that we will receive the money. So, bank account debit to financial asset, how much? We will get 10,000 here and 10,000 here. This entry will be same here also, 10,000 here and 10,000 here, right. So, these entries are same under both ACM as well as FVTOCI method. Now, say for a moment that at the year end we calculate the fair value. So, why do we calculate the fair value? Maybe the interest rates have changed and the fair value of these instruments have also undergone a change. For argument's sake, assume that the interest rate in the market has gone down. And because of which the fair value of these instruments have gone up. Okay. So, assume for a moment the fair value is 1,05,000. Fair value is 1,05,000, right. So, now if the fair value is 1,05,000 under amortized cost method, what will you do? You will do nothing. You will just sit and observe the fair value. So, why? Because under amortized cost method, the intention is to hold the financial asset and collect the contractual cash flows only. There is no intention to sell. So, whatever happens in the market does not bother me. It should not bother me, right. So, if I am following the amortized cost method, this fair value is not relevant. But if I am following the fair value through other comprehensive income method, then the gain or loss because of fair value changes should be accounted for. Now here what will happen? Here if you see, fair value is 1,05,000, right? Fair value is 1,05,000. Carrying amount is 1,01,391. So there is a gain. There is a gain. What is the gain? 1,05,000 minus 1,01,391. There is a gain of 3,608 or 3,609. This gain has to be accounted under which method? FVOCI method, right? FVTPL will come separately. We will take the same example, but under FVOCI method, you will have to account for this gain. So your gain will be accounted. You would say financial asset debit to OCI, fair value gain. Okay. How much is the amount? We said 3,609. That is what will be accounted here, right? Now, after you account for the gain, what will be the carrying amount? Under FVOCI method, your carrying amount will be 1,05,000, because from 1,01,391 you have added the gain and you will reach 1,05,000. That is the first year. Now come to second year. This is year 1. Now come to year 2. Let me just copy these entries. I have the luxury. If you get question in the exams, you have to write, repeat and write. Okay, so I'll just copy this so that. Now for year 2, what will happen? For year 2, this initial recognition entry will not be there, so you can just remove it. End of year 2, you will again have to recognize interest. Under amortized cost method, you have already computed the interest, which is 9335.08. You will follow the same 9335.08 as the interest, and under FVOCI, even here interest will be on 9335.08. Don't do the mistake of calculating interest on the fair value at the end of year 1. You will, as I told you earlier, you will calculate interest using the effective interest method as if you are doing it under amortized cost method. Now the fair value changes is only to take care of if at all you sell the asset, what will be the impact. Otherwise, the intention is also to earn interest and collect the contractual cash flows and to sell the asset, right? So the first part of it, which is collecting the contractual cash flows, for that you have to apply the effective interest method and you have to do it in the same way as you do the amortized cost method. Just the only difference is at the year end, you will compare what is the carrying amount and what is the fair value. The difference will be accounted for in other comprehensive income, right? So the interest will be the same, which is 9335. Amount collected will also be the same. Then at the end of the period, the fair value changes you have to account for. Now assume for a moment the fair value at the end of this period is 1,02,000. Okay. Now under FVOCI method, what is the carrying amount? Carrying amount will be opening balance, that is 1,05,000 plus interest 9335 minus payment 10,000. The carrying amount is 1,04,335. I am repeating once again here where you might get confused. The carrying amount under FVOCI will be the opening balance, which is 1,05,000 here, that is opening balance, that is the balance at the end of the previous period, plus interest minus payment. So you will just plus the interest minus the payment, you will get 1,04,335, because you have already increased the financial asset value by 3,609 here, right? So that you will consider as the carrying amount. And is there a gain or a loss now? Now here there will be a loss of 2,335, that is nothing but 1,02,000 minus 104,335. So what you will do is, here you will say OCI debit fair value loss, gain loss to financial asset. The amount is, we calculated here, 2,335. I will take the round figure 2,335, and here also it is 2,335. Now after this entry, what is the carrying amount of financial asset under the FVOCI method? 1,02,000, because you have done 104,335 minus 2,335. Under this method it is 1,07,26. Now come to third year. Now say for a moment, at the end of the third year, you have not yet sold the financial asset. What will be the fair value of the financial asset on the date of redemption? It will be the face value, correct? So assume I just take interest here. Payment is interest. So the closing balance will be 1 lakh, right? That 1 lakh will be redeemed. That is the amount that you will get when you sell the asset on the last day. And fair value will also be 1 lakh. Fair value will also be 1 lakh only. Now what is the carrying amount? Carrying amount is your 1,02,000 of the opening balance plus interest minus the payment. It is 1,01,273. Now, what is there a gain or a loss? Again, there is a loss of 1273. Now, if you see the net impact, here the net impact is 0. The net impact is 0, right? Now, some of you may have a doubt that when the net gain is ultimately going to be 0, what is the point in recognizing the gain? Now, the intention here to recognize the gain is, say for example, if you sold off the asset here, if you sold off the financial asset here, then you would have gain in the first year and loss in the second year. That is what is being recognized. And please remember, if even under the amortized cost method, you would have sold the asset, you would have recognized same amount of gain or loss. Okay, we will understand that when we do derecognition of financial asset. But the reason to recognize the gain or loss in OCI is because the intention is there to sell. The objective is there to sell the financial asset. If at all there is a favorable environment, say maybe at the end of first year itself they see, okay, there is a gain of 3,608, let us sell the financial asset, right? In that case, you will recognize this gain in OCI, and when the asset is ultimately disposed of, this will be reclassified to the P&L. You will take it to the P&L, whatever is the accumulated gain or loss in the period in which it is sold or derecognized. So, year 3 again, end of year 3, interest income you will recognize under ACM method, and that is 9273.86. It will be same in both the cases. Then what you will receive is 1,10,000 here, and under FVOCI method also you will receive 1,10,000, 1 lakh being the fair value and 10,000 being the interest part, right. So, here it will be 1,10,000 and 1,10,000, and then you will also need to recognize. Now, what is the recognition you will do? What is the loss? The loss, if you see, we had calculated 1273.86. So, you will recognize the loss of 1273.86 will be recognized, right. And whatever is the balance in OCI will be reclassified to the P&L in case of FVOCI method. But then in this case, if the OCI balance is 0. Now, just to explain you how we classify, say for a moment that we sold the asset in year 2 itself, okay, assuming asset sold in year 2 end. So, at the end of year 2 you have sold the asset, okay. At the end of year 2 you have sold the asset after receiving the interest, or the day on which you have received the interest, immediately you have sold it, just for hypothetical assumptions, right, so that the accounting becomes simplified. So, when you sell the asset in year 2 under amortized cost method, you have already recognized for your interest, you have already recognized the interest, and you will collect some amount. Now, when you sell the asset, what will you get? You will get the fair value from the market. Ignore the transaction cost for now. You will get fair value from the market. Correct or not? Right. So, when you sell the asset, what you will do is you will debit bank by the fair value, which is at the end of year 2 fair value we had said is 1,02,000. Right. Credit financial asset. Now, what is the financial asset value? Carrying amount under amortized cost method. Under amortized cost method, carrying amount is 1,0726. So, you will credit financial asset 100,726 and you will credit P&L by the difference, this minus this, which is 1274. Now, coming to the other part, FVOCI, assume for a moment after doing the fair valuation you have sold it off, right. So, there in that case what will you get? You will get bank, so debit bank 1,02,000, credit financial asset, this also will be 1,02,000 because you have already done the fair valuation, you have already brought the asset to its fair value and you will get 1,02,000. But then whatever is the balance in OCI will be transferred to P&L. So, you will do debit OCI, credit P&L. How much will be debited to OCI? Whatever is the balance, that is 3608 minus 2335. 2 entries you have already passed. So, the net balance is 1273 and this will be credited to P&L, which is 1273.78. Now, if you see, the net impact to P&L is same in both the cases. It is same in both the cases. But sir, when both of them have the same impact, then what is the use of doing all that OCI and all of that jhamela? The simple reason is here there is an intention from the beginning. There is an intention from the beginning that we might sell, so that you get to see in the OCI whatever is the probable gain or loss or whatever is the value that the entity will gain or lose. Here there is no intention to sell. Here we sold maybe out of some unforeseen circumstance. In that case you can sell. Nobody is saying that because you have classified it under amortized cost method, you will never be able to sell. That is not the case. You have sold it under exceptional circumstance or maybe because of need of funds, right. There, whatever is the P&L, you will recognize in the year in which it is realized. But here, under OCI, you will keep on accumulating and you will keep on observing that, okay, at the end of year 1, this is the gain unrealized, end of year 2, this is the gain unrealized, and whenever we want to take a decision, we sell it, that will be transferred to the P&L. Right. So, basically, the fair value movements will be captured and it will be shown as a part of overall equity. Let's have a look at a question on FVOCI method. An entity acquires a financial asset, they have not told what kind of financial asset it is, for CU. CU is currency unit, okay, this is the language used by IFRS. Currency unit 100 plus a purchase commission of 2, meaning to say, you paid 100 rupees to purchase plus 2 rupees as purchase commission. Now, what will you do with the transaction cost? For transaction cost, we have seen that other than FVTPL cases, means other than cases where you are measuring it as fair value through profit and loss, you will add the transaction cost to the financial asset, right. So, the financial asset will be at 100 plus 2, 102. Initially, the entity recognizes the asset at CU 102, that is what we have discussed. The reporting period ends 1 day later, okay. So, today you purchase, tomorrow is the reporting period end day. When the quoted market price of the asset is 100, okay. So, you acquired for 100, the next day also the market price is 100. If the asset were sold, a commission of CU3 would be paid. So, if you sell the asset, you will get 100 minus 3, 97. How would the transaction cost be accounted in the books of entity? Now, here there are two transaction costs, purchase transaction cost and sale transaction cost. Purchase transaction cost for ACM method and FVTOCI method, you will add it to the financial asset. So, you will recognize the financial asset at 102, that is very clear. Now, what about the subsequent transaction cost which will be incurred if the entity sells the asset? The next day when the entity sells the asset, the fair value is 100, that is what you will get, minus 3 rupees of transaction cost. So, what will you say? Will you say that the value of that asset is 97 or 100? Please remember, we said we will subsequently measure it at fair value. We did not say we will measure it at fair value less transaction cost. We will subsequently measure it at fair value. So, the fair value being 100, at the end of the reporting period, the financial asset will be measured at 100. Sir, what about the difference of 2? Because initial recognition, you said financial asset, debit 102, to bank 102, right. Now, at year end, I am saying there is a loss. There is a loss of 2. Why loss of 2? Something worth 102 is now having a fair value of only 100. So, you would say OCI debit to financial asset, which is 2, right. And this transaction cost which is added to the financial asset, that will be amortized using the effective interest method, right. As we have seen in the earlier problem, it will be added and it will be amortized using the effective interest method, right. Let us have a look at another question. Metallics Limited has made an investment in equity instrument of Castrol Limited for 19% equity stake. So, they hold 19% and because of which significant influence is not exercised. The investment was made for rupees 5 lakhs for 10,000 shares on 1st of April of year 1. On 30th of June of year 1, the fair value per equity share is rupees 25. The company has taken an irrevocable option to measure such investment at fair value through other comprehensive income, right. So, now here we have an investment in equity instrument. Normally, equity is classified as what? Fair value through P&L. But we have seen that if it is not held for trading, the entity has an option to irrevocably designate that financial asset as fair value through other comprehensive income. When that is done, then you will measure that equity investment as fair value through other comprehensive income. Gain or losses will be accumulated in OCI. Can this other comprehensive income be recycled into P&L? It cannot be. Whenever there is an equity instrument which is measured as FVOCI, then the entity cannot recycle the OCI balance to the P&L. It will always remain in OCI, or it can be transferred from OCI to retained earnings or other components of equity. It can never be taken to the P&L, right. So, here you can see that initially it has been acquired at 5 lakhs. So, initial recognition will be at 5 lakhs. You will debit financial asset by 5 lakhs and you will credit bank. Subsequently, it is at 45. Let us say 30th June is the reporting period, and so it is at 45 means 4,50,000 is the fair value. So, there is a loss of how much? 50,000. So, that loss of 50,000, you will debit the loss of 50,000 to OCI and you will credit the financial asset, right. So, that is how you will account for this transaction. When we cannot reclassify OCI balance to P&L means there will not be any impact on earnings per share. Otherwise, if you can take this gain or loss to P&L at the end, it will have an impact on earnings per share, right. So, the logic we have seen why we are not allowed to reclassify, because it is a choice given. If you don't want your P&L to fluctuate, then you always keep it outside the P&L, right. So, in such cases, this 50,000 will be debited to OCI, it will be accumulated in OCI, which can never be reclassified into P&L. So, now we have understood how do we measure financial assets under the amortized cost method and also fair value through other comprehensive income. The last category that is left is fair value through P&L. Now, as the name still suggests that this is a measurement method where changes in fair value are taken to P&L. Very simple, right. Now, under FVTPL, two things you have to keep in mind. You may have income that is of your interest and dividend, and you will have fair value gains and losses. All these will be taken to P&L. Now, whether you take interest and dividend separately to the P&L and fair value gain or loss separately to the P&L, or you just consider the fair value gain or loss and take that to the P&L, the net impact will be the same, right. For example, what I am trying to tell you here is, let us say you have purchased a financial asset at 1,000. This is measured through fair value through P&L. Okay. Now, on this 1,000 you get dividend. For example, let us say 50. 50 is what you have received as dividend. Now, what will you do with this 50? This will go to P&L, and let us say fair value at the end is 1,100. Fair value at the end is 1,100. So, fair value gain is how much? 1100 minus 1000, you get 100. This will also go to the P&L. So, the total amount to the P&L is 50 plus 100, 150. The other way to do this is, the financial asset is at 1000 minus dividend that you have received, you reduce it. So, now you are left with 950. What is the fair value? 1100. 1100 minus 950, 150. This amount goes to P&L. So, whether you follow this method 150 or this method where you take only 150, the net impact on the P&L will be the same. As I told you, fair value through P&L is the residual category, something which cannot be measured at fair value using amortized cost, or fair value through other comprehensive income will be measured as fair value through P&L. Here mostly you will see the equity instruments. There can be other instruments also if the entity wants to designate them. And again, one more thing what you have to remember is, if it is an equity instrument which is classified as fair value through other comprehensive income, upon the disposal, the balance in OCI will not be reclassified, because what the standard wants us to do is that you have to measure equity instruments using FVTPL. And if you are measuring it through FVTPL, every time there is a gain or a loss, realized, unrealized, right, dividend, interest, fair value gain, fair value loss, anything and everything related to that will be taken to the P&L. It will not be taken to OCI, right. So, these are the three things that you have to remember and understand when we talk about measurement of financial assets under three different methods. Now, there are a few minor aspects that we need to understand before we move on to the other aspects of the standard. Now, coming to financial assets which are measured at fair value through P&L, what the standard says is, if the value of these financial assets turns negative meaning it falls below 0. Now, what could be the case? A simple example could be, let us say I hold a derivative contract which is a future on a particular share, and under that derivative contract it is currently favorable. I expect to receive cash and hence it is a financial asset. But say for a moment the share price drops. So, now instead of receiving cash, I have to pay cash to somebody. So, the value has become negative, and now this financial asset will no longer be an asset for me, it will be a financial liability. Another aspect that the standard talks about is in case of equity instruments where fair value is not determinable. Now, we are talking about measuring financial assets at fair value through P&L, and we are saying that fair value is not determinable. In that case, what should we do? In that case, what the standard says is, you have to consider all the circumstances, you have to consider all the facts and still try to establish the fair value. Now, sir, we are not able to determine at all. Then cost may be a representative of the fair value, but then cost should not be the first choice. You cannot say that because I have invested in a particular company at some cost, that itself is the fair value. That is not the correct argument, right? See, in case of market quoted instruments, you know that this is the market price and that can be a fair value. But say it is an unlisted company, it is a startup has not yet started its business, okay, they are still in the idea stage, and let's say I have invested 5 lakh rupees in that startup. Now for me to determine the fair value may be very difficult because there are no similar transactions, the entity has not yet started the business, I do not know what will be the cash flow. Now in such circumstances, I may consider my cost to be the fair value and use it accordingly. But say for a moment, after 1 year when I have to do the fair value again, at that point in time, the startup has not yet progressed, they have not yet started their products, okay. The other investors who have invested in that company, they have invested at much lower valuation, okay. We are not very sure whether the product that they are starting, that will be successful. So if you see all of these factors, can I still say 5 lakhs is the fair value? 5 lakh may not be the fair value, right? So in such cases, you have to consider all the circumstances. Maybe you have to look at the recent transaction. Let us say my friend invested in the same startup considering 50% reduction in valuation. Then the shares that I hold 5 lakhs is no longer worth 5 lakhs. It is worth only 2.5 lakh, and that will be the fair value, right? So you have to look at the circumstances and determine the fair value. Even if fair value is not determinable, you cannot assume that cost is the fair value. But say the startup is progressing well, the startup is doing things in line with its projections, the product is technically feasible, they have started operations, right? Recently people who have invested have also invested at similar valuation, then the cost may be a representative of the fair value. Let's now take an example where a financial asset is valued using fair value through P&L. Okay, so let's say there is an investment in equity shares at 1 lakh. Okay, and please remember, investment in equity shares, the default choice is fair value through P&L. But then you have a choice to designate it as fair value through other comprehensive income. In that case, you will account for it as if you are using the fair value other comprehensive income method, and upon disposal you cannot reclassify that gain or loss to the P&L, and it is an irrevocable choice that you make, right? So investment in equity shares, let's say 1 lakh, transaction cost, let's say 1000, brokerage and all of that, right? So total outflow would be how much? 1 lakh 10,000. Okay, at end of reporting period, fair value is, let us say, 1 lakh 10,000. Now how do we account for these transactions? Now whenever you have a financial assets which is being measured as fair value through P&L, then the transaction cost that you have, this will be debited to P&L. You will not add it to the cost of financial asset, correct? So that is what we have understood. In case of fair value through P&L, transaction cost will not be adjusted to the amount that you have paid, right? And we will assume that this cost of 1 lakh itself is the fair value. If that is not the fair value, then you will have to determine the fair value and measure it at fair value. In case of all financial assets, you will have to measure the financial assets at fair value only. So here we are assuming that this investment cost of 1 lakh is the fair value, and what will be the accounting for it then? Financial asset, equity shares, debit by 1 lakh, 1 lakh, then transaction cost, debit 1000, to bank 1 lakh 10,000, right? So that is the first entry you pass. Now what will we do with this transaction cost? Transaction cost will be debited to P&L. So profit and loss, debit 1000, profit and loss debit 1000 to transaction cost 1000, right? Now at the year end, the fair value is 1 lakh 10,000. What is the value at which you have recognized? You have recognized it at 1 lakh. Year end the value is 1 lakh 10,000. So there is a fair value gain. So fair value gain will be recognized in P&L. So for that, the entry will be financial assets, debit 10,000, that is the fair value gain, to fair value gain on financial assets 10,000 and ultimately this fair value gain on financial assets 10,000 will be transferred to P&L which is 10,000, right. Now, sometimes what may happen is there may be interest income, there may be dividend income that would be given to you in the question. As I told you earlier, you can take them to P&L separately and compare the fair value and then account for it separately, or you can consider the inflows, whatever interest and dividend that is received, to be reduction of the carrying amount, and the revised carrying amount can be compared with the fair value of the instrument, right. As I have explained to you in one example earlier, same way you can follow. Either you can take it to P&L, the interest and dividend, or you can reduce that from the carrying amount of the financial asset. It does not make any difference because the ultimate impact to the P&L would be the same. Now, moving on, in some cases there could be financial assets which have a demand feature. Now, what is this demand feature? If you have an account with bank, you are depositing some amount in the bank, then you can go to the bank and demand for withdrawal anytime, right? Your savings account or current accounts, all of these are demand deposits. These are not time deposits. Time deposits is what? These are your FDs. These are time based. But let's say if you have a savings bank account, these are demand deposits. And the reason we call it demand deposit is the depositor can go to the bank and demand for repayment anytime he wants to. Obviously in the business hours, or if you want you can use the ATM, but these are demand deposits. Now, some financial assets may have feature of demand deposits, especially we get to see this in transactions between a parent and a subsidiary. Okay, let us say the subsidiary wants loan. Okay, so the parent may give a loan which is repayable on demand. It may carry interest rate, it may not carry interest rate, all of that keep aside, but there is a loan which will be repayable on demand. Now, in such cases, how do you determine the fair value? Because in all the problems that we did so far, what we said, you figure out the cash flows, right? And then all of you discount these cash flows to, year 0, right? And then determine the fair value. Now, when something is payable on demand, how will you determine the fair value? Now, what the standard says is, one aspect is to estimate the pattern of repayment or when will it likely be called for payment, that is one thing. And one very important thing what the standard says is, the fair value of these loan cannot be less than the amount repayable. Meaning to say, for example, let us say loan given is 10,000. Loan given is 10,000 and amount payable on demand is say 11,000. Means what? Even if the next day the lender comes and asks you, you have to pay 11,000. So, the standard says fair value has to be greater than or equal to 11,000, means it cannot be less than 11,000 because that is the amount which you have to repay whenever there is demand from the other party, right? So, if loan given is 10,000 and amount repayable on demand is 11,000, the fair value cannot be less than 11,000. It can be higher than 11,000, but it cannot be less than 11,000, right? And sometimes what happens is these loans are perpetual. Means you don't need to repay the loan. Now, when you have perpetual loans, you have to consider the feature of these perpetual loans to arrive at the proper fair value. For example, let us say loan amount is 10,000, rate of interest is 9% and this is perpetual. Means what? Every year 900 will be the cash flow. 900 will be the cash flow, right? Now, how do we determine the fair value of this? You go to the market and see for similar loans which are perpetual, what is the rate of interest? Say for example, the rate of interest in the market is 10%. The rate of interest in the market is 10%. Now, in such cases, what is the present value? You have the concept, right? Present value of perpetual annuity is equal to 900 divided by the rate of interest 10%, that makes it 9,000. So, the fair value of the loan is 9,000 and not 10,000, right? 10,000 is the current outflow, 9,000 is the fair value of the loan, right? So, if you have loans repayable on demand, So if you have loans repayable on demand, the fair value will not be less than the repayable amount, and if you have perpetual loans, consider the facts, consider the features, consider the circumstances, and accordingly determine the fair value or the present value, right? This is more or less logical, but still, it is important that you keep these points in mind. Now, with this additional understanding, we'll take up few more additional illustrations and understand how do we handle such situations in the examination. Let's have a look at a question. The shareholders of company C, so who has given shareholders of company C, provide C with financing in the form of loan notes. So basically, shareholders have given loan to the entity or the company to enable it to acquire investments in subsidiaries. So the company, that is company C, will acquire subsidiaries based on the investment, based on the loan provided by the shareholders. The loan notes will be redeemed solely out of dividends received from these subsidiaries and become redeemable only when C has sufficient funds to do so. So here, the shareholders have given money to the company will acquire subsidiaries will pay dividend, and then this dividend will be used to repay the loans. Now, whenever there is a loan transaction, from the point of view of the shareholders here, the lenders here, what is the expectation? It is the contractual cash flow of principal and interest. Now, interest rate is not given to us. It may be, a higher, it may be a market interest rate, maybe a below market interest rate, or may also be an interest-free loan, right? But there is a loan given by the shareholders to the company, and only if the company gets sufficient dividend, when they have sufficient funds, the company will repay the loan. Now, is this a loan repayable on demand? This is not a loan repayable on demand, right? That is the first thing you need to understand. And the question is asking us to analyze the initial measurement of the loan notes. Now, they did not tell us exactly whether we should analyze the financial asset in the books of shareholders or the financial liability in the books of the company, right? So now let us look at it from the point of view of the shareholders. The shareholders have given some amount. Let us say the amount is 1 lakh, just for argument's sake. Let's say amount lent is rupees 1 lakh. So 1 lakh of loan has been given, right? And we do not know what is the repayment date and all of that. And it is also not a loan repayable on demand. So we do not know what will be the value that will be redeemed, right? And interest rate is also not known. Assume for a moment market rate of interest is 10% and rate of interest under the loan is 5%. Now here, please remember, we do not know for sure the dates of repayment. Now in such cases, what is to be done? In such cases, here we need to estimate what may be the expected repayment date. What may be the expected repayment date, and accordingly we should calculate the present value of this particular loan. Now, after considering all of these, let us assume that fair value of the loan is equal to rupees 80,000. So why 80,000? Because the market rate of interest is higher. The shareholders have given the loan at a lower rate. So the fair value of loan is 80,000. Now, as far as the shareholders are concerned, for a 80,000 worth of fair value loan, they have given how much? They have given 1 lakh. Where should we account for the difference? The difference will be accounted as investment in entity C or investment in company C. So why investment? Because they are giving it in the capacity of shareholders. So think of it. Think of it that the shareholders of C gave 1 lakh. In return, they have a right on loan worth 80,000, and the balance 20,000 that has been given will be considered as investment in equity of C or a financial asset, right? So that 20,000 will not be taken to P&L, because here, if you look at the transaction, if you look at the relationship, the substance, you can make out that the additional amount given is nothing but it is like an investment in company C, right? That is the first thing. Then, in the books of company C, you have a financial liability of rupees 80,000 and equity of rupees 20,000, right? And now how do you determine this fair value? Considering the expected pattern, considering the expected repayment of interest, considering all of these, you will calculate the fair value. In examination, you will be given the information, and based on that you have to make the answer or you have to prepare the answer. But here, initial measurement, by the shareholders will be considering the fair value of the loan given. That loan fair value will be the financial asset. Any amount over and above the fair value can be considered as investment in company C. And from the point of view of the company, the fair value will be the financial liability and the amount received over and above the fair value will be the equity component. Let's have a look at another question. Silver Limited has made an investment in optionally convertible preference shares of a company Bronze Limited at rupees 100 per share. Face value also is rupees 100 per share. Now, Silver Limited, there is one company which has made an investment. So, the company making investment is Silver Limited. So, in the books of Silver Limited, it will be a financial asset. What is the asset? Asset is an optionally convertible preference share. Means there is an option to convert these preference shares into equity. Who has the option? Silver Limited has an option to convert these OCPS into equity shares in the ratio of 1:1. And if such option is not exercised till the end of 9 years, then the share shall be redeemable at the end of 10 years at a premium of 20%. Analyze the measurement of this investment in the books of Silver Limited. So, these are optionally convertible preference shares. There is a 9-year period within which the entity has to choose whether they want to convert or not convert. After that, if they don't convert, they will be redeemed at a premium of 20%. Analyze the measurement in the books of Silver Limited. Now, as far as Silver Limited is concerned, how should Silver Limited classify this financial asset? Whether it has to be at amortized cost or FVOCI or FVTPL. For that, we have to check the business model and the contractual cash flow characteristic test. Now, here, what is the contractual cash flow? See, there is no fixed dividend or fixed interest in this case. So, that is out of question. Is it a solely repayment of principal? Now, for that, the entity will wait till 9 years, and at the end of the 9th year, the entity will see what is beneficial. If the entity believes, if Silver Limited believes that converting is beneficial, they will convert. Otherwise, they will not convert. So, here the contractual cash flow characteristic test is not met because it is not solely the repayment of principal and interest. There can be a conversion which can happen depending on whether it will be beneficial to the entity or not. And hence, this cannot be classified as measured at amortized cost or measured at fair value through other comprehensive income, because you have to see the business model, and definitely in such cases when you have convertible instruments which can be converted into equity shares, you will take the decision only towards the end, and in the 9th year you will see, okay, what is the equity share price and what is the value that I will get in case of redemption. If equity share option is better, you would want to convert, right? So, there is a repayment of principal possible, I am not saying no, but these are not solely the repayment of principal and interest outstanding. They can be converted into equity shares, and hence these cannot be designated as amortized cost or fair value through other comprehensive income. In such cases, you will measure these investments as financial assets measured at fair value through P&L, and whatever is the gain or loss, that will be taken to the P&L only. Let's have a look at another question. XYZ Limited is a company incorporated in India. It provides INR 10 lakhs interest-free loan to its wholly owned Indian subsidiary ABC. So, XYZ Limited is the parent company, ABC is the subsidiary, and they have given 10 lakh worth of interest-free loan, and there are no transaction cost. How should the loan be accounted for in the Ind AS financial statements of XYZ, ABC and consolidated financial statements of the group in 3 different scenarios? So, the parent has given a loan, interest-free loan to the subsidiary, and now we have to see how do we account for this loan in the individual financial statements and in the group financial statements. Consider the following scenarios. First, the loan is repayable on demand. Second, loan is repayable after 3 years and the current market rate of interest for similar loan is 10% per annum for both holding and subsidiary. Third, the loan is repayable when ABC has funds to repay the loan. So, first condition says, or the first scenario says, loan is repayable on demand. Now, when loan is repayable on demand, what should be the fair value? Can the fair value be less than the value to be repaid? Can the fair value be less than 10 lakhs? See, if it is not repayable on demand, if it is repayable after 3 years and you do the discounting considering 10%, the fair value will be lesser. But if it is a loan repayable on demand, the fair value cannot be less than the amount repayable on demand, because tomorrow the holding company may say, please repay my loan. So, the fair value will remain to be 10 lakhs. and hence the loan will be accounted for as a financial asset in the books of holding company and financial liability in the books of subsidiary company at 10 lakhs. Will there be any interest accruing? There will not be any interest accruing on this because it is an interest-free loan. I cannot say on 10 lakhs, hypothetically I will add 10% rate of interest. What will happen in that case? If I add hypothetically 10% rate of interest, 10 lakh will become 11 lakh after 1 year. But will the entity get 11 lakh? No, the entity is not getting 11 lakh. The entity is getting only 10 lakhs. So, whenever there is a loan which is repayable on demand and it is an interest-free loan, in that case, the holding company will say, I have a financial asset worth 10 lakhs. The subsidiary company will say, I have a financial liability worth 10 lakhs. Will I add any interest? I will not add any interest because addition of interest will increase the value of the asset, whereas the asset will not be worth more than 10 lakhs. It will remain at 10 lakhs throughout the period of outstanding loan. So, no interest income, no interest expense will be recognized, and the reason for this is the loan is repayable on demand. And I will tell you the underlying logic for this. Say for example, this 10 lakhs, though it is repayable on demand, we believe that it will be repaid after say 3 years. You determine the fair value and account for it at fair value. What if the very next day the loan has to be repaid? It is possible, right? Because it is a loan repayable on demand, and that is why you will not account for such loans at a value less than the amount repayable on demand. So, the fair value will be 10 lakhs and it will be accounted for at 10 lakhs only. Now, coming to scenario B, it says the loan is repayable after 3 years. Now, it is an interest-free loan. So, today the holding company gave 10 lakhs to the subsidiary. After 3 years, the subsidiary will give back 10 lakhs to the holding company. Now, the holding company will have to ask itself that if I will get 10 lakhs after 3 years from some another party, how much of loan will I give? The loan that I will give is present value of 10 lakhs at 3 years considering 10% rate of interest, right? That is the amount that the holding company will give if somebody else says that they will give back only 10 lakhs after 3 years. Now, once you determine that present value, it will be obviously lower than the amount of loan given. So, what do we do with the difference here? The fair value of the loan and the consideration, the difference, what do we do with that? Now, as far as the difference is concerned, it is not coming out of level 1 input, so we will not take it to the P&L. That is very clear. Now, what do we do with the difference? Now, here if you see the relationship of the holding and subsidiary company, if you look at the transaction, you will understand that the amount over the fair value represents a kind of investment made by the holding company into the subsidiary company, right? That is what is the core nature of the transaction, and hence you will account for it as investment in subsidiary to the extent of the difference. And the subsidiary will also say that it has received equity from the holding company, right? So, that is why you have to look at the nature of the transaction and see whether it qualifies as an investment in subsidiary. Now, here because there is a parent and a subsidiary relationship, we can safely say that this amount, this extra amount that is given to the subsidiary is nothing but investment in subsidiary, and accordingly we will do the accounting for it. Now, the thing that you have to do in case of scenario B is to determine the present value and then account for the transaction. So, here amount of loan repayable is how much? 10 lakhs. Tenure is 3 years, right? And present value at 10%. What will be the present value at 10%? You can directly do 10 lakhs divided by 1.1 to the power of 3. See, now these simple formulas I will not keep on repeating again and again. We have discussed multiple times that the present value is future value divided by 1 plus r to the power of n, right? So, you can consider that and you can calculate because it is a single bullet repayment. If it was a kind of a structure where periodic interest would be paid, then we would have prepared a table and calculated the present value. Here it is a single payment. Present value of 10 lakhs works out to 7,51,314. So, if you prepare a table, year, opening balance, interest, there is no payment, you will just take the closing balance. 1, 2, 3 years, opening balance 751,314, interest this multiplied by 10%, closing balance this plus this, right? And again 826, interest 10%, closing balance, opening balance, interest and closing balance, right? So, 10 lakhs is the closing balance which will be repaid. So, this is the fair value of loan given. Now, you enter into the shoes of the holding company and you see that the holding company has given loan worth 7,51,314 to the subsidiary company, which will be repaid back along with 10% rate of interest after 3 years. Now, what do we do with the extra amount given? See, the fair value of loan is 7,51,000, amount given is 10 lakhs. So, excess amount given is 10 lakhs minus 751, which is 2,48,685. So, the holding company will say, I have given loan worth 751,314 and I have given equity, or I have made an investment in equity worth 248,685. Similarly, the subsidiary company will say, I have received a loan of 7,51,314 and I have received equity of 248,685. So, how do we account for the transaction? On the date of transaction, I will prepare both the books, holding company and subsidiary company. Okay. So, in the books of holding company is giving the loan. So, holding company would say loan, which is a financial asset, debit, how much? Using the fair value, that is 751,314. Loan considering the fair value 751,314 and investment in subsidiary, this is also a financial asset, debit by how much? The difference amount, that is 248,625 to bank, sum of these two, which is 10 lakhs. Okay, this is in the books of holding company. What will the subsidiary company do? The subsidiary company would say, I have received 10 lakhs. Okay, subsidiary company says, I have received 10 lakhs, out of which there is a loan, which is a financial liability of 751,314.8, and there is an equity, which is deemed equity, worth 248,685, right. So, the way you have to understand, I have been repeating this because the logic has to be clear. Holding gave 10 lakhs. To a third party, holding company would have given only 751,314 at market rate of interest. So, 751 is the loan and the balance is equity, right. That is on the date of transaction, initial recognition. Now, end of year 1, holding company will recognize interest income. So, it will say loan financial asset account debit by interest. Interest is how much? 75,131.48 to interest income. This is a P&L item, it will be transferred to P&L 75,131. So, what will the subsidiary say? The subsidiary would say interest expense debit, 751,31.48 to loan, which is a financial liability, 751,31.48, that is at the end of year 1. All these entries you will pass at the end of each year. So, you will pass at the end of year 2 and year 3. You can pass it on your own, there is nothing, there is no rocket science in that. You will pass journal entries similar way, and end of year 3 there is a repayment. What is the repayment? The holding company gets back the financial cash. The holding company gets cash against the financial asset. So, bank account debit 10 lakhs to loan, which is a financial asset, that is 10 lakhs, right. And here you will have loan, which is a financial liability, you will debit by 10 lakhs and to bank 10 lakhs, right. Now, these are in the standalone financial statements. As a group, what will be the entry? See, the loan has been given by holding to the subsidiary, that is still within the group. So, the intercompany transaction will be knocked off, they will eliminate one another, and hence there will not be any interest income or interest expense to be recognized, there will not be any loan that will be recognized in the consolidated financial statements. And also the equity investment and corresponding equity, that will also get eliminated when you prepare the consolidated financial statements. Then coming to the third scenario, which says loan is repayable when ABC has funds to repay the loan. Now here, this is not a loan repayable on demand, there is no fixed repayment schedule. Then how will the entities account for it? They will have to estimate, what would be the dates of payment, and accordingly determine what is the fair value of the loan, what is the equity component, and do the similar accounting that we have done in case of scenario B.